Good morning. It is Tuesday, December 20th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. And let's get right to the top three things you need to know as the clock hits 9 a.m. Futures relatively flat on this Tuesday morning, but big news from the Bank of Japan, which surprised investors by raising the cap on benchmark 10-year government bond yields. We'll explain what it is and what it means for other markets in just a bit.
And lawmakers propping a $1.7 trillion spending package in a race against the clock to avoid a government shutdown. Now, this marks the last opportunity for Democrats to shape the federal budget while the party controls both chambers. We've got the details for you.
And the World Bank slashes its China growth forecast for the year as the pandemic cripples the world's second largest economy. We'll break down the data later in the show, but we begin today with our top story. The Bank of Japan shocked global stock and bond markets overnight in a surprise shift in its policy stance. The central bank widened its cap on 10-year Japanese government bond yields, allowing it to move 50 basis points in either direction of its 0% target, up from 25 basis points previously. Here to break down what this all means and why it's important is Francesco Pesole, ING FX strategist. Francesco, good to see you here this morning. So what does it exactly mean for markets around the world?
Well, there are some direct implications and some indirect implications of the Bank of Japan surprise move. The direct implications obviously are on the yen and the FX market. The yen is trading around 3% higher after the announcement, and it's really, there's a chance that this has opened the way for more appreciation of the yen from now on. There are some indirect market consequences that derive from the fact that now markets may start to speculate more on monetary policy normalization in 2023 by the Bank of Japan. And given that this had been a benchmark for kind of keeping rates at check, this can have broader implications for other bond markets, and this is surely not very good news for equity and risk-sensitive assets. So these are the key parts that we're seeing being impacted at the moment, but we really need to see how this progresses in the next year.
The bank itself is not portraying this as tightening, but the market is viewing it as tightening, right? This action. And we are seeing a downward move in the dollar yen, right? And I wonder if one of the implications that we could see is a further hit to what has been this extraordinary dollar run.
Yeah, definitely. The dollar run has been largely a consequence of the Fed in 2022, the Fed being very hawkish and surprising markets on the hawkish side until markets kind of assessed that 5% would be the terminal rate approximately. Obviously, some currencies were hit by the Ukraine war and energy crisis, and the Japanese yen was partly hit by the energy crisis, but at the same time it was very hardly hit by the fact that the Bank of Japan was staying very dovish while other central banks were raising rates. So this indeed is one of the factors that looking at the next year may suggest that the dollar recovery, which we expect to happen on the back of some unstable risk sentiment, especially in the first part of this year, may not be as pronounced as we and other kind of dollar bills would expect to be. So yes, this is definitely an option. But we'll need to see, as you were saying, the Bank of Japan said this is not monetary tightening. But when you make such a big shift, markets will inevitably speculate this is monetary normalization, at least. So they will need to, it'll take a lot to convince the markets that it's actually not.
With that market speculation, the markets, at least here in the U.S., have looked really closely at the terminal rate to get a sense of how the U.S. Fed is going to act. What's the kind of analogous metric or benchmark that we should be monitoring in Japan?
Well, first of all, we need to see whether they are willing to allow kind of the band, the tolerance band for 10-year government bonds to go even higher than the current 0.5 percentage point. We must remember that the outright target is still 0%. So they allow a plus 0.5% to minus 0.5%. Obviously, the current environment rates go to the 0.5% level. So this is the first level, and then we need to see whether they effectively start withdrawing some of the monetary stimulus with higher target rates. So there's a lot of things that they can do. We must remember in April we'll have the change in the government of the Bank of Japan. Kuroda will step down. So this is also very relevant because we could see a complete change with the new governor potentially.
Yes, and that's something that the markets are also trying to consider. Something else that's a part of this story is Japanese ownership of foreign assets, which is relatively high. We're showing a chart of that as a proportion of Japanese GDP. So if indeed there is tightening or continuation of what appears to be this big step here, what implications does that have for that ownership?
Well, this it's a very interesting topic, also from an FX perspective. Should Japanese assets become more attractive from a yield perspective at a time when markets are still not fully convinced to get back into riskier assets like equities, given market instability and still tightening by certain central banks into a recession? Then we could see kind of the attractiveness of Japanese bonds become much higher in this current environment. And just looking at the FX perspective, this would also mean more inflows supporting the Japanese yen and probably going against mostly the dollar and the euro.
ING FX strategist Francesco Pesole, thank you so much for joining us this morning and breaking this all down. Congressional leaders rolled out a bipartisan government funding bill this morning that's aimed at closing loopholes in election law and specifically would prevent another January 6th style attack. Yahoo Finance's Rick Newman is here with the details. What do we know about this, Rick?
Well, it looks like this is going according to script. This is rolling out about the way everybody expected. Congress is probably going to pass this by Friday. Which means we're not going to have a government shutdown. There are not going to be any big surprises, I don't think, for markets. It doesn't look like there are going to be any substantial tax changes, for example, in this new bill. It looks like they are going to add almost $45 billion in aid for Ukraine. That is about $8 billion more than President Biden had asked for, so I think that's good news. And this does include this bill you mentioned called the Electoral Count Act, which would basically prevent any future challenges to presidential elections and kind of clear up some of the confusion that we saw in 2020 and 2021 about whether the vice president can actually block the next president from coming in. What does it take for Congress to be able to say that some states' slate of electors is not valid? So it substantially raises the threshold for any objections to the vote in the states. And it clarifies that the vice president's role is ministerial only. He does not have a decision-making process in a federal election. And I think just about everybody who wants us to have solid and safe elections would be happy about that.
So there's lots of other stuff in the bill too, right? I mean, that was interesting, and that did seem to be a direct response to January 6th. But there's also enormous defense spending, for example. What else stands out to you as especially notable in the bill? I
mean, defense always wins when it comes down to the wire because everybody just packs everything in. So the defense budget is going to be $858 billion in fiscal year 2023. I mean, at some point, it's going to hit $1 trillion. That's pretty remarkable.
Is Ukraine aid in that part of the spending?
No, I think it's separate. It's separate. But there probably is some commingling in terms of weapons that we're providing to Ukraine. And one of the things that's happening here in the United States is we are cranking up fairly long-term production of things like missiles and artillery shells and sort of the the Wheaties of a military budget. And we had substantial stockpiles of that stuff, but those are running down because Ukraine is just burning through so much ammunition, including their own ammunition. So that's one of the reasons we're going to see sustained defense budgets for some time, which is to replace that stuff that we're giving to Ukraine.
Really interesting stuff.
All right. Thanks a lot, Rick. Appreciate it. Yeah. Well, the World Bank has slashed its China growth outlook for 2022 and 2023, citing weakness from the country's long COVID-19 measures and its shrinking property sector. The new forecast, 2.7% growth in 2022, 4.3% growth in 2023, well below its September estimates and below the official target from China of around 5.5%. So this happening, of course, amidst the changing picture for COVID in the country as China is now changing its definition of what it attributes to COVID deaths directly. So basically, China is now saying it's only counting deaths as being as a result of COVID if it's a direct result, not if the person has COVID and then experiences complications, but direct respiratory effects. So just a lot going on there between that and trying to game out what it means economically.
Yeah, and economically, with what we've heard from the World Bank, and I mean, China has already kind of vowed to really look at its economy and try to figure out any type of stimulus efforts that it can roll out to stabilize the economy. And even today, they had set their benchmark lending interest rates. They actually kept this unchanged. That's the fourth month in a row that they've done that. And that keeps with some of the forecasts that were expected. But that's remaining at 3.65% for their 1-year loan prime rate, and then the 5-year 4.30%. And so with that in mind, they're trying to continue to be more stimulative at a time where they know that the COVID scenario and the reality of the zero tolerance policy and now a reopening that they're trying to effort and move forward with could have even more detrimental risks economically, and trying to offset that too.
Yeah, and I think you're learning that this situation, COVID, the reopening, the policies of the government, it's not going away next year. There was, I think, a view at some point things would start to get better and there would be a pivot in the economy next year. And I look at this new report put out by the Japan Center for Economic Research this week, totally flying under the radar. They're saying that China won't surpass America's in size by 2035 after all. This paper is calling for their economists. They're looking for China GDP growth rate will fall to the 2% range in the 2030s, in large part because of what is happening today on the ground in China.
Wow, that's amazing. I mean, certainly it seems clear that the sort of throwing the doors open, reopening in the short term, it seems like it's going to happen much more in fits and starts than just sort of that reopening and everything's
2% growth for China's economy. This is not what many people were banking on 3 years ago.
To be fair, like, who knows what's going to happen in the 2030s? I mean, like,
well, I do. You do too. Brad, so do you.
Nah, I mean, that's
okay.
That forecast that far out.
Yeah.
I don't know how much
we'll be here to report it when it hits 1.5%.
Yes, we will be here.
Yes, indeed.
And got to move on to some breaking news that we are just getting. Wells Fargo agreeing to a $3.7 billion settlement with the Consumer Financial Protection Bureau. That's to settle a variety of allegations surrounding the mistreatment of customers. The head of the CFPB, Rohit Chopra, said in a statement that Wells Fargo's rinse-repeat cycle of violating the law has harmed millions of American families, and calls the settlement an initial step for accountability and long-term reform of this repeat offender. Indeed, this is not the first time we have seen a settlement between the bank and the United States, and the shares are taking a bit of a hit this morning. We will bring you more developments on that as we get them. Coming up, why our next guest says inflation will not fall as much as hoped. Fantastic. We'll speak with UBS's Jason Katz next.
As we continue to wind down 2022 and look ahead to the new year, our focus, much like the Fed's, remains on inflation. And according to our next guest, as inflation improves, more financial conditions loosen, making the Fed's job even harder here. So joining us now to break down all of this and much more is Jason Katz, UBS Managing Director and Private Wealth Advisor. Jason, good to have you here with us on this holiday week. Given what we've seen in the markets leading into these final weeks of the year, all the focus now is clearly on 2023 and just what the Fed's pathway may be. What are your biggest expectations and the tenor that the Fed is going to strike going forward once we get into the new year?
Yeah, look, if you annualize inflation over the last 3 months, we're actually looking at headline inflation at around 3.5%. But that's not the 2% inflation target. So we have this catch-22. The reason manufacturing inflation is down is the reason service inflation's up. We're not at home buying stuff, we're getting out and doing things. And the real catch-22 is the more that headline inflation improves, the more financial conditions loosen. And the more that those conditions ease, it makes the Fed's job all the more harder. So there was no surprise of what was said or done for that matter at the Fed meeting. And the market's reaction suggests that investors are getting the memo. The Fed is saying what it means and meaning what it says, and they're unapologetically hawkish. And I don't think they're going to relent on tighter policy until inflation's under control. What they may relent on is what that target ends up being. It may be a 3.5% target, not necessarily 2%. We shall see.
Jason, maybe I'm getting inspired by that really cool bull on your wall there, which I'm going to take this offline. I need to know where you got that thing. But what stocks should people be bullish on after a very challenging year this year?
Yeah, I mean, listen, you want to find industries that are thematic in nature. And I think there's some investable areas, regardless of whether we have this recession, how deep and how long it lasts. You take, what's happened with the war in Ukraine and the lessons learned there. Companies aren't as focused right now on price and efficiency. What are they focused on? Safety. So you think about energy, think about cybersecurity, or you think about food and agriculture. Food, for that matter, getting clean water to polluted areas, or companies that boost the agricultural yield by making vertical farms. So you're looking at areas that, regardless of whether the war persists or inflation rages, are going to continue to thrive. Cybersecurity is another incredibly investable area. We can't be beholden to our enemies for our energy, our food, and now we need to protect our companies, our governments, and our schools. And cyber spending is a prerequisite for every business leader I speak to.
Jason, I'm going to take the flip side of this. What do you think? What are you avoiding at all costs going into 2023?
Well, I'm avoiding some of the really crowded trades. For instance, a lot of the defensive areas like consumer staples or utilities, for that matter. Utilities are very bond-like. And listen, I manage money for individual high net worth investors, and everyone was in the pursuit for safety and yield, especially recently. And the valuation in an industry like utilities that doesn't really grow earnings and are regulated are hypersensitive to moves in rates. And should the 10-year get back over 4.5%, there's meaningful downside there.
What type of shift would you need to see in not just the Fed's policy, but perhaps in the broader environment for technology, which has been a sector that has led us through bull rallies and bull markets in the past, for that to be a kind of reconcilable decision for somebody to make within their portfolio?
Look, investors are a creature of habit. And having done this for 3 decades, I see people have the muscle memory of buying what they're familiar with and what has worked. I'm not saying to abandon tech or big tech for that matter, but 60% of their earnings come from overseas. Any strength in the dollar or any weakness overseas or weakness in consumer ad spending just don't bode well for that industry. So for that to get investable, growth can't come down as much as feared. And if it doesn't, then I think you could definitely see a resurge in technology, but there are far better, more investable areas at this point. Fixed income, being one of them.
Point well taken. Jason Katz, UBS Managing Director and Private Wealth Advisor. Good to see you. Happy holidays.
You too.
Straight ahead, we are tracking a move in EV maker Lucid. More on that move next. Welcome back. Let's hit a few hot Yahoo Finance tickers ahead of that opening bell on Wall Street. Shares of Lucid in focus this morning after the EV maker announced that it's completed its at-the-market equity offering program. Lucid sold more than 56.2 million shares of its common stock, raising over $1.5 billion. And as is typical with offerings like this, Lucid saying it's using it for general corporate purposes, which in this case is to get more cars produced and out the door. The other problem here, guys, with Lucid is there's still concerns around what is the true demand for this very expensive Lucid vehicle, the high end of this high-end vehicle here, over $130,000, and reservations coming out of that third quarter already starting to come down a little bit. Not a good thing, not what you want to see from an EV startup.
Yeah.
Go ahead.
Well, they have just marketed towards a very affluent consumer at a time where Tesla was really pounding the pavement on mass market. We saw more entry in the mass market side over the next couple of years as there's more battery development again, or among at least some of the more legacy automotive players. That's where you're going to see some of that additional kind of affluent market play come in. But I think as of right now, for the Lucid category, a lot of people that are either looking at a Lucid or looking at a Tesla or comparing it even against a Rivian, these are some super pricey vehicles out there. And now it's just a matter of how people are going to, in this environment, continue to want to finance a vehicle like that, regardless of how far it can go on one charge.
Yeah, I mean, the competitor to this might be more the Porsche electric vehicle,
Porsche,
right?
Mercedes EQ3.
Yeah, I mean, I think that you're more talking at the luxury end of the spectrum. Maybe the Tesla S
or the X.
Yeah, maybe that's a little more.
I could see you in a Lucid,
comparable.
Julie. You got that Lucid.
I mean, I could
think you would
see
love
myself in a
I think
Lucid.
I think you would love the Lucid. I just see it. I
Fire
just,
up the graphics.
I think
That's the difference. I mean, what's interesting to me too is this placement that they are doing. Who is buying the shares? Because most of it was raised by their biggest existing stake. Their stake remains unchanged the way it was structured at just over 60%. But it's not as though it is getting funding from new and different sources, by and large. It's from the existing investor that is putting more cash into this.
You do have to know, when is that moment of reckoning? Just because you come up with a flashy and you have produced or a concept car and you're making these electric cars doesn't mean you're going to survive for the next decade. Now when you have well-established automakers like a Ford and GM finally getting their act together in V's. I mean, can we say Lucid is going to be around a decade from now?
But it's apples and oranges, right? The GM and Ford stuff, the Lucid customer is not the GM and Ford.
So you're saying Lucid is the Porsche of the next decade, maybe?
Maybe, or at least it's. I'm not saying it will or it won't be around. I'm just saying, like, you have to think about where it's fitting into the equation, right? And it's not fitting into that mass market as you were discussing.
And the model that those previous legacy automakers have really leaned into is the ability to have not just the dealerships, but the number of existing clients within their network that they could say, hey, yeah, just come in, trade up, and we can keep you in our same Mercedes network or keep you in our same Porsche network. Because You love the logo. Why not? Yeah, exactly. All right, let's go from cars to cereal. Shares of General Mills, they are moving here on the day. It's down by about 4.25% pre-market following an earnings beat for the second quarter as the company exceeded expectations on the top and bottom lines while also raising its full year fiscal 2023 financial targets for net sales and operating profit. I won't go over too much time here, but here's what I have in summary. Cereal was up slightly, higher prices as well. That was passed through. Häagen down is what I called it as well in my notes, as Häagen-Dazs did decline. And you had a little bit of a recall as well on the ice cream front. And then volume, that was also down as well during the quarter.
What stood out to me is, and I would say is a red flag, is organic sales in their pet food business. That is primarily Blue Buffalo. They were flat or unchanged year over year. Operating profits down 34%. And General Mills is calling out inventory adjustments at retail. So it's something I need to do a little more work in because we did get positive results in food from a Chewy. We talked to Sumit Singh last week. He called out strength in food. We had positive results in food from a Petco as well. So unclear to me if this General Mills losing market share in food, but again, something I have to dig into a little bit more.
Yeah, it seems like the volume thing is really what people are focusing on, and one of the reasons that the stock is trading down here. So that, I mean, organic sales volume, I'm seeing down 6 points, so that's a bigger drop than estimated.
And another food company showing strength on top line, but still, they're all pushing through. They all continue to push through price increases, and the volume is not keeping pace. So the consumer looks to be pulling back.
We're getting some notes in from our team too. It seems like they're set to raise prices again in early 2023. So any continued pass through of price increases to the consumer, that could have a near-term impact, at least on what investors are expecting on price realization for the company.
And they're not seeing any mitigation, right? The company's still forecasting input cost inflation of 14 to 15% for the full year, including double-digit inflation in the second half. So that's not very reassuring.
No, not at all.
No.
Well, it sounds like more cereal out of the bag, maybe a little more air in the box, Julie.
Oh,
so it sounds like. Shrinkflation. Yes.
So what's your breakfast cereal?
You guys are gonna make fun of me again. I said this 3 months ago when we were talking General Mills. It's still Rice Chex. I love Rice Chex. Everybody hates me because
Where
it's
is
bland,
the flavor in
boring.
Rice Chex?
There's just something about that corn when it hits your tongue with some nice ice cold milk, not oat milk, not almond milk, regular whole fat milk. It's just good. I used to eat boxes of stuff, and I still would.
There is nothing about it because there's no flavor
What's yours?
in that.
What's
What
yours?
about yours?
Cinnamon Toast Crunch.
Oh, that's good though. See, I'm not hating on
Everybody
it.
loves
Don't
Cinnamon
hate
Toast
somebody else's yuck, as our former friend, as our friend Sam Rowe said.
Now,
Don't yuck
you
someone
can
else's
guess
yum.
that I like some organic crunchy cereal. You know, Heritage Flakes. I mean,
what?
Yeah.
What are Heritage Flakes? What a terrible name.
Super American. Awful. They're just flakes.
Yeah, I just fell asleep thinking of that.
That's what I eat more often. I mean, yes, given the choice, I would eat Cinnamon Toast Crunch.
Go get some Fruit Loops, Julie.
But I value my teeth and my
Get
health.
some Captain Crunch.
No.
We can always get new teeth.
What is a Heritage Flake?
It's just a flake. What's
Of what? Corn?
Of wheat and stuff. I don't know.
Heritage.
It's wheat. It's just like. Oh, thank you. Thank you for the. Don't yuck my yum, man. All right, that's the opening bell on Wall Street. My goodness, here.
Brad, you need some Heritage Flakes.
Getting a lot of grief.
Me too. I'm gonna try
You're
it.
just projecting because you're
I'm gonna
Rice
try it after the
Chex.
show. Heritage Flakes.
Brad Smith, help us out here. My goodness, I'm getting a lot of grief on this. You don't even know what it is.
I don't have to.
criticizing
I'm not buying it.
Well, the Dow is down right now out of the gate. It's flat, just barely to the downside. And look at that. It's just barely moved in to the upside there. So a little bit of hyper oscillation out of the gate here. Seen positive and negative sides of the tape thus far. The Dow is going to figure out its mind in a moment. The Nasdaq Composite, you're seeing that down by about 0.5% early in trade here on the day. Over the past 2 days, down by about 2%, given some of the declines that we saw yesterday. And then additionally, S&P 500, you're seeing that down over the past 2 days by about 1.2%. Here today, down by about 0.3%. Let's take a look at some of the sector activity that we're seeing here early in today's trade, as we've got some mixed activity on the tape here. Financials leading the charge as of right now. You've got a few movers fractionally higher. Financials leading it, and energy is trying to figure out if it wants to be part of that party as well. Real estate, though, bringing up the caboose, real estate and consumer discretionary. You're seeing that bounce around, but both of those down roughly about 0.7%. Let's also just briefly take a look at some of the Nasdaq 100 movers here intraday. And early out of the gate, mega cap tech stocks, they are all in the red. Apple down a little more than 1%. Tesla down 2.5%. You've got Nvidia also lower by about 1.2%. We'll keep a close eye on all of those names. But for right now, back on to the table with some Heritage Flakes.
Akiko Fujita is on the Heritage Flakes train.
Oh.
I'm happy to
CEO of
report.
Heritage Flakes just viewed us. Said he's a big fan of the show. Big fan of the show.
Okay, let's talk about Stitch Fix, shall we? Because the stock got downgraded to underweight over at JP Morgan. The bank expects 2023 to be another tough year for the online clothing company, citing potential macro headwinds. And they're also skeptical on the Fix freestyle model's ability to drive new client acquisition. The stock is down about 1.5% today. It's virtually collapsed so far this year. So the freestyle model, now remember, Stitch Fix used to be a company where you would put in a bunch of different preferences for your clothing. They would send you a box of stuff, and you would say, I like this, I don't like this, whatever, send back what you don't want. Now, they give you recommendations, and you can pick before they send it to you. Mm-hmm. So that's the freestyle model that is different than and they've been trying to pivot to that, and it's had very, very choppy success.
I got my cute baby Christmas tree last night, so I'm feeling seasonal. I'm in a good mood, so I'm not going to take this analyst to task for only downgrading the stock now after it has fallen.
Well, they
82%.
were at neutral. They were at least at neutral. At least they were not downgrading it from overweight.
Man. I will add this though. They do bring up a good point. Because this company is so focused on cutting costs, trying to make an earnings number and stay afloat and stay alive, they're cutting advertising by 50%, according to this JP Morgan note. And this business historically has been driven by increased advertising. You suck people in off the internet, they get free trials, they like the service, they sign up. And if they're cutting back that aggressively on advertising, best believe they're going to have a challenging couple more quarters.
But the fashion delivery segment right now, we're seeing lean more towards rent and then maybe purchase, more so than have somebody pick and you purchase. Because if we're taking anything away from the most recent quarter, compare Stitch Fix. Their net revenue decreased 22% year over year. Active clients decreased 11% year over year. Compare that to Urban, who has Newly underneath of their belt. They saw net sales increase by 185% increase in their subscribers during the quarter. So that's what drove it for Urban with Newly. And then you saw Rent the Runway achieve a record quarterly revenue. That was up 31% year over year. 28% of subscribers adding one or more paid additional items into their subscription programs. And so it's more coming back to the number of people that are renting right now, where it's possible for the different lines, because that's not a possibility for the men's
unclear if this stock will
right
be
now.
stitched up next year, Brad. Unclear. Time for some Heritage Flakes.
It is. Oh no! Now sticking to my cinnamon toast crunch here, guys. Coming up, Amazon has had a brutal 2022, giving up the last of its pandemic gains. Sazi's got the take next.
Shares of Amazon are down almost 50% this year. They've lost all of their pandemic-fueled gains, falling back to where the stock was trading before COVID-19 started shutting down the U.S. economy. The stock slump caught the attention of the man sitting to my left, Brian Sazi, and that's where we find his thing.
That's all I do, just track stock moves all day. But this was actually starting to get pretty startling. I have a story on the Yahoo Finance homepage with some more numbers detailing the sell-off. But let's go through this Amazon stock price by the numbers first. Year to date, Amazon stock is now down 50% year to date. That is a huge move for an industry leader and dare I say pioneer like an Amazon. The stock is trading at a 52-week low. That was hit yesterday before coming in today's session, and is the second worst FANG performer year to date. Of course, that is Facebook / Meta, Apple, Amazon, Netflix, and Google. The worst performer, I believe, is Netflix. So really a startling year here for Amazon. Now, looking around what Wall Street is saying, we're starting to see some more bearish notes come in on Amazon right smack in the middle of the holiday season. First up, friend of the show, Mark Mahaney, earlier this week, he said he's lowering his estimates and his price target on Amazon in the wake of some analysis that he did, saying there's ongoing softness in online retail and cloud computing demand. So that's Mark over there. On the other side, you have my former boss, Jim Cramer, tweeting to me this morning that he's actually buying Amazon stock here on those 52-week lows. So there you see Jim's tweet to me this morning. Interesting to see him making those moves. Now let's break down why the stock is in fact, I would say, tanking. You have a weak holiday season. We saw weak retail sales hit last week. The market did not like that. You've seen a couple retail warnings, and the read is that perhaps even Amazon, even though it is a leader in retail, of course, it might be coming under pressure this holiday season. Recession fears, of course, hurting consumer spending, but also the spending by enterprises and perhaps how much they will spend on cloud services. And then maybe, and Julie, I'll toss this up to you guys, Julie and Brad, maybe some loss of confidence in CEO Andy Jassy here. He hasn't really had, I think, that big, amazing quarter since taking over, and that's a big red flag.
Well, it's a tough cloud environment for them to continue to sell into their existing clients and then get net new clients as well. So you look at the compression in the cloud and the number of net new customers that they're going to be able to sign on, or either make sure that they retain the existing amount of customers that they do have and the seats, the licenses they're in. That's one issue. The consumer discretionary issue that we've continued to talk about, and the number of people that are still willing to buy within any retail category, knowing that they're tightening their own dollars that are going out the door. That's going to be a different issue, because that's a line of the business that is not necessarily just the profit margin winner for them. If anything, it's web services and advertising, which, what else is a red flag? The number of companies pulling back on their advertising dollars that they're spending even into a high conversion environment like Amazon too.
Right on. And to that end, fire the take here on Amazon, which has been a challenging year. Amazon is still Amazon, but ... And by that I mean Amazon is still a leader, of course, in cloud services and retail, advertising. It does so many things right, but the market is not giving you the trade. And at this point, I think you're going to see a lot of analysts simply call Amazon a show-me stock going into next year. By that, I mean they have to show you a good quarter. They have to come out here and finally beat earnings, finally beat on sales, and not come out here and warn that their costs are out of line.
Grinch has had a lot of
play
this quarter.
A lot of play.
Yeah.
Grinch is just chilling.
I think
just
it's
like
pretty
me.
straightforward. I think you had a pull forward effect, a re-rating of the stock. Amazon's not going anywhere. It's just growing slower.
Yep.
That's. I mean, it's pretty straightforward.
Well said.
I think. All right, coming up, choppy waters are still ahead for autos, at least according to our next guest. We'll talk to Wells Fargo's Colin Langan next. Automakers are revving up for the new year, but our next guest says investors should still expect choppy waters or perhaps bumpy roads ahead, with inflationary prices and volume decline still weighing on the sector. Wells Fargo senior analyst Colin Langan is joining us now with his outlook for next year. Hey, Colin, good to see you. And you basically, when you're looking at the whole of the industry and what sales we could expect next year, you think that the consensus is a little bit too optimistic. Talk to us about your targets and why you think that they're going to be lower than perhaps what the street's pricing in.
Yeah, absolutely. I mean, I'm about, I think on average, if I look at the core metrics, about 9% lower on 2023 than most of the traditional supplier and OEM estimates for next year. I think there's really two key drivers that I think about. One is just light vehicle production. I think, we're expecting just 2% year-over-year growth, really with a lot of concerns driven out of Europe and China. China's actually already, above where they were before COVID. And they had some incentives this year. I think there'll be payback. And I'm still very weary of the Europe energy crisis and what that might do to the consumer over there, or just potentially slight disruptions given the supply chain could cause some production blips. So I think we're going to see more conservative, particularly from the suppliers, guiding on production year over year to be much lower than what people are baking into their numbers now. I think the benchmark tends to be around 4%. And then secondly, I think people are expecting, particularly for the suppliers, this inflation recovery tailwind from 2022 inflationary costs into 23. I think that's absolutely going to happen. I think what they're underestimating is the continued inflation into 2023. And we're already seeing, January 1, there'll be a 20% minimum wage increase in Mexico. That's a big hub for labor, for suppliers. And so already day one, we're going to have inflationary wage pressure. So there's already signs before we even started the year that pressure is going to be there again. And we're very worried about pricing for the automakers. And if they're under pressure for profits because pricing is coming down, it's going to be harder to get concessions for those costs from the automakers.
So do you believe the automakers' earnings estimations already priced this in, or does there need to be another revision to the downside on this?
I think there's significant downside to the OEMs, and we're underway both GM and Ford. I think pricing is just hasn't even started yet, and I think it's going to be a continual drag as we go through next year. There's already signs that pricing is under pressure. We've looked at the last 6 months. If you look at the absolute unit sales are fairly flat in the U.S., but inventory is up about 500,000 units. Not a good sign. Some of that might be in transit, but we're still, not seeing as it was at sort of the peak demand levels, where the minute it hits the dealer lot, it gets pulled away. Now it's starting to stick. We also saw there's data out there saying that dealer profits are down 15% in November year over year, which is really showing they're starting to sell more vehicles below MSRP, which I think is the sign that pricing is starting to correct. So it starts with the dealers, then it'll hit the OEMs as they start upping their incentives.
Colin, we got news this morning that there will be a delay, or likely a delay, till March next year in the new $7,500 EV tax credit. How big a problem will that be to the first half for Tesla?
I mean, the way I understand the rules is actually with this delay, it's only delayed a part of the rule, and it's still very unclear, quite frankly. So, but my understanding is that it's part of the rule, and there's, they actually might benefit from this because there's up to 7,500. I actually think they'll only get half of that for the battery component, which is 3,750. The interpretation that's out there is that until the rules are actually implemented, you don't have to meet those requirements, but the rules will be effective. So I actually don't know that it necessarily is going to be a bad news for Tesla. Actually, I think there could be extra credits available maybe for the first 3 months of the year.
I do want to pick up on Tesla, Colin, because you didn't talk a lot about Tesla in your outlook for next year. But obviously, it's been very much in the news. The stock has not been doing well as of late, although it did initially pop a little bit yesterday on the thinking maybe Musk was going to step away from Twitter. We've talked to you a little bit before about his sitting in many seats, wearing many hats, et cetera. What's your current thinking on the situation?
Yeah, I mean, we remain equal weight. I think there's clearly pros and cons to the stock. I mean, it's very concerning, about the weakness that we're seeing in China. We're seeing incentives go up and sales actually are not increasing there. And there's driving concern is, are we going to start seeing that in the US and Europe? Is that sort of the early days of sort of softening demand? And I think that is really more of the investor along the sort of the large institutional investors' top concern. I think for Twitter, everyone I think has seen that Elon could multitask. So the actual multitasking is not something I think traditional institutional investors are that concerned about. But I do think there's a little bit of rising concern about, maybe potential brand damage from some of the headlines that are coming around the Twitter situation. I think it's very, very unclear at this point if that's having a meaningful impact. But, I think, we'll see how it all resolves. But as you go into next year in terms of good news, the IRA is going to be a nice help. Tesla and GM are probably the biggest beneficiaries of IRA, or almost certainly the biggest beneficiaries of IRA. And that should result in a nice quick boost in demand as all of a sudden the vehicles get cheaper because of these tax credits.
Colin, give us more good news. What's your top pick for 2023?
I mean, I continue to like BorgWarner. It's a supplier that is, I think, going to be a leader in the transition from internal combustion engine to EV. It's trading at a discount to the group, and yet I think it'll be by 2025 one of the sort of top 2 or 3 global e-powertrain suppliers. They're going to do a spin of some of their internal combustion engine businesses that I think will have a really good free cash flow profile that'll support that valuation. But the RemainCo, after they have the spin, will have 6% above market growth, which is going to be one of the top among the supplier group. It'll have margin expansion as they start scaling their EV from about $850 million to $4 billion by 2025. So I think there's good near-term and long-term story here for the company.
Wells Fargo senior analyst Colin Langan, always good to see you. Happy holidays.
You too.
Elon Musk is giving the power to Twitter Blue members, announcing that future policy decisions through voting will be left solely to subscribers. That follows his poll, which resulted in calls for him to step down from the helm of the social media company. Reports out this morning, guys, that he is actively searching for that CEO. That, of course, is according to, or just hit the wires from David Faber over at CNBC. But still, maybe he's actually taking this poll seriously.
I would hope so, because a lot of Tesla shareholders would also want to see more of that time focused on the vehicle, the car company, or just the broader kind of mindset that he's brought to Tesla for years, that he is the central force, everything operates around Elon brand that Tesla has been for so long. Now has a competitor in a company that is not publicly listed anymore, that is a side project, but has continued to siphon off some of its most notable profiles on the platform because they're just disgruntled with how Elon has run it to this point. And even for the cuts that have taken place, hopefully somebody else can take over Twitter and turn it around.
I mean, he's been pretty clear from the beginning that he didn't want to run it permanently, right? Yeah. He said that in the deposition for the case that was going on in Delaware regarding Tesla. Remember, he made it clear that he didn't want to keep on being the CEO. So, he said he would abide by the results of the poll. He didn't say when he would abide by the results of the poll, to be clear. Somehow, despite the fact that it's a private company and he's cut spending, we're still giving them free advertising every damn day we talk about Twitter.
I wanted to bring up to you, Julie, because I sent along that op-ed in the Time by Roger McNamee, he's been on with us, long-time tech executive, and he brought up a good question. Are we covering Elon like the media covered the lead up to President Trump's win? And there are some similarities.
Sort of not being critical enough or not viewing it through the correct lens is sort of what Roger was getting at. Yeah, I mean, I think that is it's definitely worth thinking about.
Yeah, absolutely. Well, we've seen some of the former Twitter employees also start their own offshoots of a different social media platform as well, Spill. So we'll see where some of the usership starts to migrate over to Spill or Mastodon, some of the other options out there.
There's a lot of different options that are popping up. And remember, Twitter briefly banned mentions of those other networks on its network, including Facebook and Instagram as well. I think they've backtracked on that policy. It seems like day to day, it's difficult to keep track of what the policies are, right? Including the fact that Musk made that poll and then said, oh no, only the Twitter Blue paying users' votes count.
Good thing I took that Facebook link off my Twitter profile. Just kidding. Coming up, we'll continue with our look ahead for the energy space. That's next.
Looks like your account is deactivated.
Oh, no.
Energy stocks have crushed the S&P 500 this year in a good way, and Wall Street is betting the sector's outperformance will persist in the new year. Yahoo Finance's Alexandra Semenova has the story for us. Alexandra.
Well, guys, oil prices have been on a downtrend recently, but that isn't swaying the energy bulls. Energy stocks are poised to charge higher next year, according to much of Wall Street, and that's thanks to relatively cheap valuations and earnings estimates that appear to be a bright spot in an otherwise grim outlook for S&P 500 earnings next year more broadly. Energy has the lowest price-to-earnings ratio of any sector in the index, and it's actually only one of two sectors in the S&P 500 that has recently seen upward revisions to its earnings expectations, while Wall Street is slashing earnings expectations across the board for every other sector. Another point that really underscores Wall Street's bullishness is, according to FactSet data, energy stocks have the highest share of buy ratings, about 63%. Strategists have also pointed out how prudent energy companies have been this year, even against a backdrop of higher oil prices and bullishness around oil. And this year's performance alone is enough to be bullish going into next year. Not only has energy surged more than 55% year to date, but it has no competition compared to the other sectors. It's the only one that is not in negative this year, while the broader benchmark index is down roughly 17% year to date. And this will mark the second year that energy has outperformed the broader market, and next year could be the third.
And we've also talked to some strategists about how the energy companies, which used to spend sort of like crazy, are not spending quite as much, even as prices are pushing higher. That could be something that could be helpful.
Mm-hmm. So there are two sides to the equation here, it appears. It seems like most strategists have two different perspectives. On one hand, Wall Street does expect oil prices to be higher. Goldman sees Brent averaging $98 a barrel next year and WTI crude averaging about $92 a barrel in 2023. That's lower than previous estimates, but meaningfully higher than where it's trading right now. So there is the expectation that higher oil prices will continue to boost the sector. But on the other side, there are some strategists who point out that the comparisons between oil as a commodity and oil stocks are actually a bit misplaced, because when it comes to the companies, you're looking at how they're spending, you're looking at their valuations and earnings per share estimates. Evercore's Julian Emanuel actually recently pointed out on the show that WTI crude oil went negative in 2020, and the sector still outperformed by a long shot.
Appreciate you watching, Alexandra Semenova. Thanks so much.
Always watching.
Great analysis. We'll see you later. All right, the magic man, Bob Iger, may be back atop Disney as CEO, but his magic wand hasn't yet solved the problem of a poor-performing Disney stock price. Let's put a few stats around it for you. On Monday, Disney's stock price hit its lowest level since March 2020 due to a disappointing debut for Avatar. It marked the fourth straight day of losses for Disney. The stock is down 12% in December, bringing its year-to-date drop to 44%. Disney shares are the third worst performer on the Dow this year, trailing only Intel and Salesforce. There I am with my Mickey ears on. Very proud of my stat of the day today. All right, straight ahead, we'll reset the show, but stay on all things markets. Do not go anywhere. Welcome back to Yahoo Finance. I'm Brian Tazi here with Julie Hyman and Brad Smith. Markets, well, they're inching into the holiday weekend, seeing some mixed action across the board. We're seeing the Dow, S&P 500 slightly in the green, and the Nasdaq, well, that is slightly in the red. And here's what's on tap this hour. The future of crypto regulation. We'll chat with Senator Tina Smith on crypto's outlook. And is it time to eat up pizza stocks after a weak 2022? We'll talk to one top restaurant analyst on all things pizza. But Brad, over to you first on all things housing.
All right, thanks so much. Well, U.S. housing starts, they were down 0.5% in November to its lowest level since August of 2020, while building permits tumbled roughly 11% to their lowest level since June of 2020. The National Association of Home Builders CEO Jerry Howard is here to discuss. Jerry, great to have some of your time this morning. What we've also seen, even in the earnings of some of the companies that have reported, for where we are still seeing some weakness, it's not just in the number of homes that are starting to be contracted, but it's also in the prices that people are willing to pay for homes. Where do you expect there to be some strength that the industry can eventually see, especially as the Fed is continuing on its own pathway in this rate policy?
Well, first of all, the area of strength is one that is always strong, and that's the very high end of the market. Those who are buying second homes and the very wealthy, they have money now, they can afford it, and they're still buying. So the builders that focus in that segment of the industry are doing relatively well. The rest of the market is not looking very strong for 23. I'm particularly concerned with the first-time home buyer quadrant, and I'm concerned with that because that really dictates the health of the entire chain of housing. And so it's very, very difficult to build at that price point right now, and it's something that we're watching very carefully.
And so, Jerry, it's Julie here. What changed it? Is it just a matter of when the Fed stops raising rates that things will be allowed to improve?
Well, the Fed and their interest rates has an impact up and down the chain, obviously. In the first-time home buyer market, it's also the fact that cost of construction is still like 10% higher than the inflation rate is. So cost of construction, the cost of capital, it's all playing into it, and that's having an impact where we firmly believe that we're in a housing recession right now.
Jerry, some commentary recently from RH CEO, of course, of the high-end home furnishings company. That CEO says the housing market is collapsing. Do you share that view?
I think we're in a housing recession right now. I do think that this is going to be different from 08. I don't think people should panic here. And the big difference is in 08, we had a glut of supply. Here we do not have a glut of supply. In fact, we have a supply shortage, and that's going to limit how low prices can drop. So I think we're going to be in for a rough year in 23. But I think the floor is a lot higher than it was in 08, and will come back a lot faster. We're looking for a turnaround in early 24.
What will lead that turnaround?
I think what will lead that turnaround is going to be a reduction in interest rates, and I think we'll ultimately get our supply chain back in order, which will help bring down construction costs. And I also think that policymakers are starting to realize that a lot of the policies we have at the local, state, and federal level are adding to the cost of housing, and I think they're finally going to do something about it.
National Association of Home Builders CEO Jerry Howard, good to see you. Happy holidays. It's been a painful run for cryptocurrency investors as digital assets endured several waves of volatility this year. To break down the best and worst crypto stocks to come out of the chaotic roller coaster ride that was 2022 is our very own Jared Blicker. Jared.
Hey there. Well, I wanted to present the winners and losers in the crypto market, at least on the stock side of things, but we're only finding losers. This is a year-to-date showing of our heat map, and let me just sort by performance here. It's bad at the top. Okay, so XNet up 2% year-to-date, but everything else firmly in the red. In fact, over half of these names are down about 80% or more. You take a look at a lot of the charts, and they're all pretty similar, at least when you get down to the bottom couple rows. Now, over the last 3 months, some of the bigger names like Robinhood, Square, Master Strategies there, those are not down quite as much. Now, the exception is Tesla. Tesla is its own story. We know that the purchase of Elon Musk of Twitter has really weighed on that stock as he's been selling it. But just check check out some of these stocks. I want to show you some of the charts that I'm looking at here. Here's CoinDesk. That's down 46% over the last 3 months, 86% year to date, making all-time record lows. I don't know if it is today, but it definitely was tomorrow. And those are the kind of charts that we're looking at. Now, you take another stock like Hood, which is a lot more diversified into the, I guess, the traditional finance realm. It's not making new lows here. In fact, you could call this somewhat of a constructive base. I don't like the fact that it's trailing off here, but that's my analysis of the stock side. Now, in terms of the crypto side, since all these stocks are highly levered to the crypto instruments, here's Bitcoin. So in order for these stocks to turn around, we're going to have to see crypto prices come up again. However, we've been seeing a pattern of big drops here, followed by consolidation, followed by big drops again, and we just saw this in November. Is that going to happen? Well, we don't know here, but I will say this. On a 10-year basis, it's pretty clear. One of the big levels here is 20,000. We're currently at 16.9. We have to reclaim 20,000 and stay above for a lot of technical traders to start getting interested in Bitcoin again, and that's kind of the kahuna. So that's why I'm referencing this first. But take your pick of some of the other majors, Ethereum, what have you. Going to have to take out those 2017 highs. Otherwise, we're still mired probably in this crypto winter for some time, guys.
All right. Thanks so much. Appreciate it. All right, sticking with the crypto space, we got to follow the other story we've been watching, not in the public markets. FTX founder Sam Bankman-Fried has reportedly agreed to be extradited following Monday's chaotic court hearing. Here with the details, Yahoo Finance's Alexis Keenan. So we talked yesterday, but things are obviously changing day by day here.
They are, Julie. And you use the right word there, chaotic. That's how reporters who were in the courtroom described the hearing yesterday. And that's when Sam Bankman-Fried was expected to enter agreement to waive his right to fight extradition to the United States. And then, according to Reuters, hours later, he then recanted, agreed to be extradited. And so he is expected to return to the court in the Bahamas as soon as today. He could also be extradited physically to the United States as soon as today. But still, that hearing was so highly unusual in that Bankman-Fried's Bahamian attorney told the judge that he was, quote, surprised to see Bankman-Fried in court at all. Also, you had a Bahamian prosecutor reportedly telling the judge that he understood Bankman-Fried intended to enter that waiver to fight extradition after a weekend call that he had with Bankman-Fried's U.S. attorney. Now, the hearing eventually wrapped yesterday after Bankman-Fried and his Bahamian attorney said they needed to see the indictment that the Department of Justice had filed against him. Now, it's kind of hard to imagine that Bankman-Fried had not been provided the indictment. It is a public document. So it kind of raises the question if a more detailed indictment was perhaps told to his lawyers. Is that coming? That's a question. And also raises the question as to why Bankman-Fried would agree to waive his right to fight extradition at all. Could it be the condition is inside the correctional facility in the Bahamas? It is said to be unsanitary and not a very great place to be, even by prison standards. Also, there's the opportunity for bail in the United States. Remember, he was already denied bail in the Bahamas. White-collar defendants in these financial crimes often are given bail in the United States. However, all of the criminal defense attorneys and former prosecutors that I've been talking with, they say that given that Bankman-Fried would be probably deemed a potential flight risk, that he may not get bail right away, even if he does show up in the United States.
Alexis Keenan, thanks so much. Okay, before we head to break, let's highlight some key 2023 calls by Morgan Stanley's software analyst Keith Weiss. Weiss said in a new note, ServiceNow is his top pick for next year, while also viewing Microsoft and Palo Alto Networks as top likely outperformers. On Microsoft in particular, Weiss says this: our primary work suggests a strong demand signal for Microsoft and key secular growth opportunities like public cloud, data management, and security, which should sustain growth in the commercial business better than investors fear. Coming up, CVS and Walgreens begin restricting pain medicine purchases. Julie has more on this and other top headlines next.
Let's get down to business now with some of the other headlines that we are watching this morning. U.S. pharmacies are having a tough time keeping fever and pain medications in stock as flu, respiratory syncytial virus, RSV as it's known, and COVID-19 infections surge, particularly among children. CVS and Walgreens are both limiting purchases of pediatric cold and flu medicines as they face supply constraints and high demand. And consumers have been stockpiling medication. That's also contributing to the crunch. The shortage extends beyond over-the-counter drugs as well. The prescription antibiotic amoxicillin, often used to treat nose and throat infections in children, is also in short supply. A new report from an independent panel of experts says the Food and Drug Administration lacks a clear strategy in its fight against smoking. The report found that the work of the FDA's Center for Tobacco Products has been made more difficult by the volume of product applications it receives and the amount of agency leadership turnover it has encountered. The review group calls on the Biden administration to establish an interagency task force to make enforcement of the tobacco laws a government-wide priority. And Federal Communications Commission Chairwoman Jessica Rosenworcel distributed 4 forfeiture orders in August penalizing cell phone carriers AT&T, Sprint, T-Mobile, and Verizon. That was for allegedly mishandling access to their customers' real-time locations. Those carriers could face roughly $200 million in fines, but the FCC can't issue the orders without approval from at least 3 commissioners. 2 Democrats on the commission have voted to approve the orders, but their Republican counterparts have yet to vote. And we should mention the FCC's leadership does have a vacant seat. The Senate has gone a full year without voting on the Biden nominee, Gigi Sohn. Brad?
All right, thanks so much. Well, Minnesota Senator Tina Smith, currently advocating for regulation and oversight in the crypto industry. She, of course, took part in the Senate Banking Committee's hearing on the FTX collapse. She lays out FTX as a case for what could happen without proper oversight. Take a listen.
The crypto world of FTX shows us what can happen when we don't have basic consumer protections in place. And, you know, crypto is a relatively new thing, but we know what to do to make sure that our markets are fair and that financial institutions know their customers. So it seems to me that our job here is to enforce the laws that we have, make sure that we are plugging holes where they exist, and making sure that our enforcement agencies have the authorities and the resources they need, or we're going to see more disasters like this.
Yeah, that's
Here to discuss the outlook for crypto regulation is Senate Banking, Housing, and Urban Affairs Committee member Senator Tina Smith, alongside Yahoo Finance's Akiko Fujita. Great to have you here with us today, Senator. First, when you looked through the evidence and what has been researched from your committee's perspective in terms of the abnormal investments, the abnormal deposits that went into some existing banks as well, what loopholes do you believe should immediately be cut off or closed so that crypto firms cannot further gain access into some of these banks in the way that they have to this point?
Well, thank you. Yes, and it's great to be with you today, and thank you for that. I think there's a whole range of places where we need to really understand what's happening with crypto. And one of the spaces, as you mentioned, is in banking. And what is the exposure of American banks to the increased and extreme volatility in the crypto world? That is really what was behind the question that Senator Warren and I asked the big federal regulators, FDIC and the Federal Reserve and the Office of the Comptroller of the Currency, to really understand this for the first time. So far, it seems as if the United States banking system is not deeply enmeshed in the volatility of crypto, but yet there are examples where it seems that it could be a big issue. So we want to understand that to make sure that we are protecting the foundation and integrity of the banking system in the midst of this deep volatility and riskiness of crypto.
Senator, listening to the hearing last week, it certainly felt like there was a glaring divide among lawmakers about what exactly should be done within crypto. And we heard the Banking Committee chair, Sherrod Brown, over the weekend saying that he believes that the possibility of banning crypto altogether should be floated. Where do you stand on that? Do you think the SEC or CFTC should consider an outright ban?
Well, my view of it is that the horse is out of the barn on this, and we are dealing in a global world of crypto investing, or betting, depending on how you see it. It seems to me that increasingly crypto is looking like a betting scheme rather than an investment scheme. But nonetheless, we have to make sure that consumers are they can bet, they can invest in nearly anything that they want to. That's their right. But we need to make sure that they're operating in a fair environment, in a fair market, where they understand the true risks and the rewards. And that's what I was getting at in my questions at the committee last week. Understanding, we know how to basically provide a fair market for consumers, and we need to make sure that those standards are being applied where we can in the crypto world.
So within that, part of the difficulty is just making sure that these companies are not just operating in or have some type of touch point in the U.S., but are also even headquartered here so that there is more of a jurisdictional approach that the U.S. can have in terms of its priority here. So what steps would you be willing to move forward with, or are you considering moving forward with, to say if a company is not headquartered in the U.S., then would they then have access to U.S. customers cut off in crypto?
Yeah, well, you raise a very good point. This is a global ecosystem, and we don't control all of that. We only control what happens here in the United States. And I think we know that American investors and bettors will just deploy their resources overseas when they have the opportunity. But at the very least, they ought to know that there are some protections when they are dealing with American U.S. regulated entities. And I think that there's some benefit to that. Look, I get the argument that any kind of regulatory scheme provides an imprimatur of legitimacy to crypto, and we have to be careful about that. But at the end of the day, I think we need to do what we can. So what I favor is looking at what the existing authorities are, especially at the SEC, but also in the Commodity Futures Trading Commission. Look at what the existing regulatory authorities are, and then figuring out how to make sure that those agencies have the resources to enforce, and also plug the gaps where we see that they exist around regulatory authorities so that we can protect consumers from the basic ways that they need to make sure that their personal resources aren't getting intermingled with corporate resources, that the company is exercising its fiduciary responsibilities and not trading for its own interests first. The basic consumer protections that we provide in other environments.
With that said, how would that have protected customers in the FTX collapse? If you look at what triggered all of this, it was the international side, the offshore exchange, that really started the dominoes falling. U.S. regulation, how would that have protected those consumers?
Well, you raise a really great point. And as I said previously, the interaction between international businesses domiciled overseas and those that are under a regulatory authority in the United States is very, very complicated. And we can't control all of that. But I think that when you have U.S. domiciled companies, we can at least in that circumstance try to provide some of those basic consumer protections. With regard to FTX, which as you note is headquartered overseas, at the very least, we need to make sure that when Americans are betting on those things or investing in those things, that they at least understand what the risks are. And I think that was not the case here.
We do know that lobbyist spending has just multiplied over the past 4 years as the space has gained more traction and as there has been more discussion about regulation. Companies want to have more of a voice, more of a say in exactly how that moves forward. But what we did see come to light within the FTX allegations that were put forward was campaign finance violations as well. Do you believe that there are other companies, based on your review, that are also guilty of that same allegation here?
Yes, well, so allegedly the FTX company and Sam Bankman-Fried used client money to make political contributions. That has been alleged. The investigation is ongoing. That is patently illegal and is completely unacceptable. And we have to get to the bottom of that to understand what really happened. I think that the the thing that people are so concerned about, that I'm so concerned about, is that there seems to be sort of a kind of a no rules culture that exists in so many of these crypto firms. And in fact, I think we asked that question at the banking committee. Do you think that the abuses that we see at FTX, we see this in other firms? And some of our testifiers said, yes, they thought that they would. So I think it shows that there's a ton of work to do to get accountability here to protect consumers and make sure that we're preventing this kind of abuse to the best extent that we can.
Finally, Senator, when you look at the hearing in the Senate as well as the House, a lot of the questioning that came out kind of been making the rounds with, those who are in crypto saying, well, this is kind of an example that lawmakers don't have a full grasp of this space and how it works based on the types of questions that came out. What do you say to those who say, are lawmakers really equipped enough with the knowledge to understand this space to regulate it?
Well, I get that point, and I think that crypto is a new thing in many ways, relatively new thing. But at the end of the day, crypto is a thing that people can invest in or bet on. You got to be able to understand the difference between the underlying technology of blockchain and then the various assets that are developed built on that blockchain technology, and understand that fundamental difference, and understand there's a difference between assets that are crypto assets and exchanges and all the different corporate structures. But at the end of the day, it isn't that complicated. We're talking about either a gambling or a security or commodity that people are betting on. And there needs to be basic consumer protections and anti-money laundering laws to protect consumers. And that's what I think we should be focused on.
All right, answers that a lot of consumers and citizens are looking forward to hearing more on. Minnesota Senator Tina Smith, thank you so much for joining us here this morning, and happy holidays to you. Alongside Yahoo Finance's Akiko Fujita, you can hear more from Akiko at 11 a.m. Thanks so much to both of you.
Thank you.
And coming up, everyone, taking flight, we're going to break down the travel outlook ahead with Citi analyst Stephen Trent next. The airline industry has been on the rebound since the pandemic as it tries to keep up with the influx of demand. Will it be clearer skies ahead, or is turbulence still in the cards for 2023? We have Stephen Drent, who is the Citi research analyst, here to discuss. Great to have you here with us this morning. When you think about the holiday travel that we're seeing and the demand that even coming into this holiday travel season, that airline executives are continuing to point out and say this is either the golden age of travel or that demand is extremely strong. How far does that continue to hold true if we continue to see consumers kind of pull back on some of their discretionary spending?
No, appreciate the time, and thanks very much for having me on. So I do think that this ongoing demand has some legs. You still have a lot of pent-up demand out there from people that have not been able to get out over the last 2 years. So one of the consequences of what seems to be happening in the economy is perhaps a shift from a lot of consumption of stay from home, work from home, pandemic era type items that were very popular to quote unquote reopening. And it sounds stale to say reopening because we've been open. But you have that ongoing shift from goods to services, and you have a dearth of airline capacity per capita that's supporting pricing. So we think that there's still revenue headwind out there over the next couple of quarters.
Well, Stephen, to that point, I mean, man, these stocks have not done well. Considering how much we keep talking about how the travel industry is booming, you know, American down 30% this year, you know, Alaska, Delta down 15%. Why haven't these stocks done better? And what can we expect from them going into 2023?
Sure, great question. So it has been a tough year overall. So, you know, as you said, Alaska is down this year. The S&P is down a little more. So, you know, the broad market has not been easy. We've spent a lot of time this year with investors going risk off. We started with Omicron, then we went to a fuel spike. Now we're dealing with higher interest rates. With all of that, we have seen earnings return. We've seen some carriers out there, such as Delta, telegraphing that they will generate multi-billion-dollar levels of free cash flow over the coming years. So I would say there is at least somewhat of a disconnect at the moment between what kind of numbers these companies are putting up and price action in the market. But certainly the market itself hasn't done great. So you actually have seen you know, some carriers do a little better than the market itself, even though they're also down.
Stephen, you have a buy rating on United, and United recently made some headlines with a giant order of some new Boeing airplanes. You know, how do you think those new planes will transform their profits looking out over the next decade?
Sure. So I have to be, you know, maybe I can give you an industry answer on that one. You know, when we've seen across the big three is a need to modernize their fleets, a need to upgauge their aircraft. So moving away from the sub 120 seat range into these larger gauge aircraft that have really good seat mile cost profiles versus the smaller ones. So in terms of what that potentially means from the earnings perspective, I think is kind of the relevant thing to focus on now. Certainly when you get big orders come in, and I'm speaking generally here, definitely there can be some concerns around CapEx and how a particular airline is going to fund a fleet upgrade. But these fleet upgrades can really make a big difference in terms of economic performance and fuel efficiency. So, you know, I think that's kind of the more relevant piece of the pie longer term, even though a short term, yes, elements of the market could have a knee-jerk reaction to what happens with CapEx.
Do you believe that that'll drive more of these partnerships, more of these alliances? And we also do have a short clip from the Mesa Airlines CEO off of their most recent alliance. And this is just one of many, but let's roll the clip real quick, and then we'll come back to it on the other side.
When we first wanted to set up a meeting to talk about a wind down, they said, don't even bother coming to Dallas. We don't want to talk about a wind down. In fact, you know, they wanted, not only did they try to incentivize us offered us an extension of the contract. So, I mean, I just have a problem with that because it's, you know, really denigrates the hard work of all my people. And the bottom line is we went to them because we were losing so much, like $5 million a month, and just said, look, we need to get out so that we can continue to operate the business and provide jobs for 3,500 people.
Okay, and so do you believe that, given what you were mentioning a moment ago in the CapEx scrutiny, that there could be, if there were just additional planes purchased, that we'll see more of the partnerships like Mesa and United, and even like we had seen in the Northeast Alliance between American Airlines and JetBlue?
Yeah, so I think that we are in a transition period at the moment. So I think there are cyclical things that have been associated with the COVID pandemic. And then I also think there are some structural things. So speaking of the latter, for example, over a long term, regional, I would argue, has been having a tougher time for a while. The market's continuing to move to mainline. Airlines for years have been moving to larger gauge aircraft. And we've seen, for example, all of the major aircraft manufacturers respond to that. All of the newer versions of planes that come out virtually all have more seats on them. So, I think in terms of alliances and what could get agreed to, or what airlines could agree to going forward, absolutely, I think we are going to see kind of out of the box type opportunities to form alliances that will not necessarily be within any particular existing global alliance like Star or Oneworld. So absolutely, I think there's a chance we see more of this because of those structural items that I mentioned.
If we are indeed, and a question on capacity here, I suppose, if we are indeed headed into a recession that's going to dampen the amount of travelers or the propensity for leisure travel, and even see some cutback on corporate travel, which is already trying to rebound to the best extent possible right now, what does that mean for the need for capacity to actually be restored to pre-pandemic levels?
Yeah, absolutely. So, what we've actually seen in our, some of our recent survey work has been a little bit of softness in domestic managed business travel. So I think part of that is, yes, coming from interest rates going higher. Some of that is coming from Zoom and telepresence supplanting some in-person meetings that would have been done on a pre-pandemic level. And then I think you also now have blended business travel. So one of the structural items, for example, is a lot of people are no longer in the office 5 days a week. So maybe they're doing 3 days live and 2 days remote. That creates kind of more flexibility around what we could see in terms of blended trips now, people traveling for business / personal reasons as opposed to a pure business trip. In terms of capacity coming back, and what could happen on the pandemic level, on the economic level with rates going up and maybe some slowdown, a whole bunch of pieces to that. So the other things that we're seeing, for example, is international momentum in several instances is actually overtaking the booking curve momentum we see in the US market. So those network carriers with very good international exposure, very good transatlantic exposure, like Delta, for example, probably going to continue seeing revenue tailwinds as some of these international corridors appear to be 6 to 9 months behind the United States domestic in terms of their recovery. The other thing, high level, that we would be thinking about is if we are indeed going into an economic slowdown, what are the implications for oil prices? So, they have come off a bit. Jet fuel kerosene's come off a little less than oil prices, for example, but they've still come down. So I think the confluence of those factors and some continued shift away from goods and into services is not necessarily a bad setup, for the network majors.
Great analysis for us here today. City analyst Stephen Trent, good to see you. Happy holidays.
You too. Thank you.
Yahoo Finance's Auto Geeks Rick Newman and Professor Romanian hop on with us next to run down their review of GM's pricey new electric Hummer. We'll be right back. The new all-electric Hummer has been put through its paces by Yahoo Finance's resident auto experts, Rick Newman and Praz Subramanian. Both are here with us now to share their impressions. Praz, I'll go to you first here. Does this thing impress you? It better impress you because, well over $100,000, right?
Yeah, yes, for sure. It was the first edition model, well over $100,000. You know, when I was originally kind of scared to pick this thing up because it's supposedly so huge, and you got to drive from the city. I meet up with Rick that day, but I mean, the thing drives pretty well, very smooth.
Look at these guys.
I mean,
it's such a good buddy,
it's
Phil.
basically the size of a full-size pickup, but it actually all electric power, right? 1,000 horsepower, 3 motors. Drives really smooth, easy to drive. I think that was fine, Rick. I loved it. I mean, look, for $100,000, you better get what you're paying for. And I think that there's nothing else like it on the road right now, from my point of view.
What scares me is driving with Praz.
Where's your pumpkin spice latte?
Luckily, I'm in the driver's seat there,
you're
but
driving.
I don't look quite as calm when Praz is driving. But so I mean, you know, when an automaker says we're going to price this, you know, the sky's the limit. Basically, they let the engineers go to town, which I think is cool. So, I mean, I would never in a million years pay $100,000 for this. But I love that General Motors is building it because the engineers get to tuck all these things in there that they've been dreaming about for years, like the crab walk feature. Praz can tell you more about the details of that. But, I mean, let's just go back to what the Hummer is. So General Motors started making the Hummer, they licensed the name from AM General when Arnold Schwarzenegger bought an original military Hummer, so then they sold the Hummer H1. What most people saw as a Hummer was the Hummer H2, which was this gigantic beast built on a GM pickup truck frame. And if you were lucky if you got 10 miles to the gallon on that. So when gas hit $4 a gallon in 2008, and then GM declared bankruptcy in 2009, that was the end of the Hummer. And they actually tried to sell the brand to a Chinese company in bankruptcy, and that deal fell through. So it's almost by luck that GM even still has this brand. And I love the fact that they're bringing it back as an all-electric.
Was it moving sideways in one of those?
That was the crab walk. That was a crab walk. So, it can turn the tires all in one direction and go like this, and go like this, and go like this. It's
now, why would you want to do that?
Because you could.
So you don't have to get the keys from
It
somebody
has
else
something to do with off-road driving that no one's ever going to do.
I actually was sneaking into a parallel spot, and I put in crab mode, and it just went whoop.
Guys,
okay, so
sorry, go ahead, Brad.
Well, I was just going to briefly ask here because, I mean, it was great to see you guys in the shot of reporters in cars getting coffee, but at the end of the day, it still does come down to how far is this thing going to go? What is the charge versus the previous Hummers that were gas guzzlers?
So this car can get 340 miles per charge. It's got a massive, massive battery. This thing weighs almost 10,000 pounds. I just want to quickly say that, you know, Brad, yeah, it is pretty capable. I mean, you're paying a big price, not very efficient from a watts per mile point of view. But I got to say, one point I'll make is that this is basically what the Cybertruck should have been, and GM has made it, right?
Yeah.
This thing is big, badass, and it's like super capable.
Okay, so who's buying this thing? That's
And
my question. Because the market for the original Hummer was you would buy one of these things because you wanted to be super obnoxious. It was it was sort of implicit in buying these. You were going to be the jerk on the road with this thing, burning lots of gas, big hulking machine. So
that's the New Yorker view of the Hummer. There's also a Texas view of the Hummer, which is kind of the opposite. But the H2.
It's you're modest and you want to meekly go along the road. No.
Love-hate car designs always succeed. Because when people hate it, that makes the people who love it even more. But this is why this is a smart move for GM. Now you can buy this beast, and it's environmental because it's electric. It's probably not that environmental because, I mean, you're still sucking. You're still burning fossil fuels to generate the electricity that goes into the car, but it's not getting 10 miles to the gallon anymore.
Yeah, I mean, it's I don't want to say virtue signaling, but
it totally is.
But it's a.
But you'll say that.
Like,
That's
hey,
Rick
I
will
can
say
be badass, and I can still be, sort of my carbon footprint is neutralized. You know what I mean?
All right. Well, we'll see. We'll see.
They're going to sell every one of these they make.
Okay.
There are plenty of rich bros who want this in their driveway right now.
All right.
I'm predicting Sazi will have one.
I'm predicting Miles Ellen will get one too.
He wants me to get a Lucid. He's going to get a Hummer.
Well, Miles has the driveway. You just need a driveway.
I do driveway.
All right, we got to go, guys. We're going to talk about pizza after this. Pizza consumption is returning to a semblance of normalcy. Yes, the pizza consumption cycle. Where are we in that cycle? We'll talk about it next. After surging takeout demand in 2020 because of COVID-19, our next guest says sales of pizza are returning to some semblance of normalcy in 2022, and she predicts strong growth ahead for the carryout sector. Bank of America analyst Sarah Senator joins us now. Sarah, it's good to see you. Thanks for being here. Pizza has been a really interesting space, actually, over the last couple of years. What does normalcy look like when it comes to this business?
Yeah, you're right. For a segment that's been around for a very long time, and for most of us, it's sort of a part of our kind of, if not daily, weekly, or monthly existence. There's been a lot of change over the last couple of years, primarily catalyzed by COVID, I think. And, as you said, we do think that most of that was transitory, and we're getting back to a point that looks a lot more like it did pre-COVID, at least with respect to kind of the rate of consumption or how people are accessing pizza with respect to, carry out versus drive-through. But pizza, like every other part of the restaurant industry, really saw a huge change with the onset of COVID in 2020 as everybody shifted to more at-home consumption. And of course, the large pizza chains, that's really their stock in trade, is getting food to people to eat at home. So a big tailwind from like I said, from a consumption perspective, certainly early on. But, we've given a little bit of that back more recently. And I think now we're seeing kind of collectively kind of 3-year trends or growth rates that are very consistent with what we saw before the pandemic hit.
Sarah, who's winning the pizza category on the third-party delivery side from your analysis?
People who use aggregators are very loyal to the aggregators they use. And I think that's only been amplified by the subscription services. So what we see is that among the restaurant companies, when they partner with aggregators, they usually choose to partner across the board with all of the aggregators because they find that there really is incrementality with each aggregator platform because they have a different customer base, whether it's because of geographic strength or just, kind of habit or certain other preferences that consumers have. So it's, I think, less about, which aggregator is winning within a specific space and more from a restaurant's perspective, the aggregators, what they offer in terms of access to customers.
Sarah, why have the burger and French fry stocks outperformed the pizza stocks this year, and can that continue next year?
I think it is really a function of this normalization that we've been talking about. So when you think about pizza consumption, a real sort of significant amount of pull forward, if you will, 2020 and into 2021. So we're seeing a bit of that correction or adjustment. The same store sales growth, at Domino's is now on a 3-year basis, 17% for the industry. So for the overall business. So 17% over 3 years is a pretty healthy, robust number. It ends up averaging, somewhere in the 5.5% range. That's very consistent with what, previous run rates were. It's just that it has been distributed unevenly. So slower than that this year, although we're certainly seeing recovery and faster than that in the prior 2 years. So I think that is different from some of the other QSRs that have seen more what I'll call level loaded, sort of more consistent growth, not as fast in 2020 or 2021 as the pizza restaurants, but faster in 2022. And again, I think, what we'll see as we look out next year is that a lot of normalization has happened, and we should expect virtually all the restaurants to kind of reconverge on their historical rates. So faster for the pizza restaurants and potentially slower for some of the others.
Bank of America analyst Sarah Senator joining us today. Thanks so much for the pizza and other fast food analysis as well. Got us all hungry and ready for lunch here. Appreciate it, Sarah. Coming up, Justin Bieber isn't saying sorry to H&M after calling the retailer out for selling his merchandise without his permission, apparently. We're going to discuss that next. It is time for Cover Time. We've got 3 stories, 1 minute each today. We start with this. Justin Bieber, the Biebs, saying one time, don't buy H&M's merchandise of him, calling the clothing trash in an Instagram post, saying he did not give consent for the retailer to sell the items. H&M has pushed back on this and said that they went through what are the necessary approval procedures for their company, but Justin apparently didn't approve any of this.
I mean, who knows what really happened, right? He says he didn't. They say they went through the proper channels. I don't know what the effect of this is. Will people actually, I mean, like, I don't know what the stuff looks like. Does anybody know?
Well, it's not good quality. I was just in the malls. Now, first of all, my general sense is the quality continues to come down on apparel, especially on the buttons.
But it's H&M. Do you go to H&M for quality?
H&M is, in my humble view, getting even worse as all these companies try to cut costs. Some of these clothes, I can't imagine making through 2 washes.
This is them? Okay, this is all trash, actually. He is correct. So here's the other thing that he's tried to, and he has come out with his own lines, or at least he said it's trash, and my own sentiment echoes the same thing, but he's had his own lines in the past too.
Yes, indeed. All right, Christie's International saw record art sales in 2022, rising 17% year over year to $8.4 billion, driven by large estate sales and smaller collectors. All right, well, stock market under pressure, people investing in art.
Yeah, I mean, I guess that's part of what has driven it. It's still, you know, there's still, as we have talked about frequently when it comes to the markets, higher income consumers are still doing okay. Christie's also talked about the role that millennial investors and younger buyers have played in this. They are more comfortable bidding online, so that, you know, they've made up a bigger. I mean, it makes sense. The population over all ages, it makes sense that millennials would be a bigger chunk.
Yeah, I get my art in Home Goods, so yeah.
They got Home Goods. Look, live, laugh, love.
Basically, that's what I have in my place. I've got like saying all of it. Yeah, actually, yes.
Yeah, it's a new consortium of buyers potentially. It's also, if you see an exit in some of the kind of more affluent consumer base into art, being able to move art overseas, it's kind of analogous with if you wanted to own crypto and just have that be able to transfer into another account elsewhere overseas as well. It's a way of moving money around.
Target got some great art last night when I went. I'm going to go back and get it. $10 a pop. Looks great.
And finally, 3M has pledged to end its production of what are referred to as forever chemicals, PFAs, by the end of 2025. Research has linked these chemicals to kidney cancers, thyroid disease, high cholesterol, all according to the Environmental Protection Agency. 3M has been the subject of a lot of lawsuits about this as well, and regulatory actions, and it's taking a charge of over $1 billion to take these out of circulation. But I guess it figured that the cost is worth it considering the scrutiny they've come under.
And this, amongst other things, too, have been a really major overhang over 3M stock. And we've talked to CEO Mike Roman about this very issue. I'm surprised the stock is not up on this because you would think this removes a little bit of an overhang to their balance sheet. But nonetheless, now you have to think about a 3M having to reinvent a lot of its product lines. And of course, that will come at a big cost.
And this is not the only company that uses some of these forever chemicals, because 3M was part of a lawsuit that the state of California moved forward with. That also included several other companies, including DuPont, within that lawsuit. So where they'll kind of adjust their operating procedures to make sure that they've got the other necessary materials within there. That'll be interesting.
Yeah, well, this put pressure on the likes of DuPont to follow suit. All right, that does it for us three. Coming up, Akiko and Rochelle are going to speak with Amazon Labor Union President Chris Smalls amidst this busy holiday season. You don't want to miss that.
Welcome to Yahoo Finance Live. It is 8 a.m. on the West Coast, 11 a.m. on the East. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. Curveball. The Bank of Japan tweaks a monetary policy stance that kept a lid on bond yields for years. The move has implications for the dollar and the cost of borrowing in the U.S. Saxo's head of FX, John Hardy, is going to explain why. Crypto in the House. A divided Congress means political impasse galore in 2023. But will a Republican-led lower chamber mean big changes are in store for the likes of Bitcoin? Cowen's Jared Seberg is going to be joining us with his views on the topic. And the next hurdle. U.S. workers pushed unions back into the mainstream consciousness over the last 12 months. Arguably, none have been more instrumental than Amazon labor union's Chris Smalls. We're going to get his take on where the movement goes next. First, though, let's do a check on major indices right now. And we are seeing green arrows for a change here. The Dow up 113 points, the S&P 500 up 9, looking to snap that 4-day losing streak. And the Nasdaq up 14 points here. In terms of sectors, we're watching financials and energy, the biggest gainers so far on the day, and Treasury yields firmly in focus. Yet again today, we're going to explain here in just a bit, but take a look at where things stand right now. The 10-year yield is at 3.68%, up slightly here. And on the longer end, we're looking at the 30-year yield at 3.7%. And Rochelle, of course, we're all watching this because of what happened overnight at the Bank of Japan.
Exactly. I mean, the Bank of Japan really shocked markets overnight in a surprise shift in its policy. The central bank widened its cap on 10-year Japanese government bond yields, or JGBs, allowing it to move 50 basis points in either direction of its 0% target. Now, this is up from 25 basis points previously. And this is something that the BOJ has been holding on to for a long time. I think people were not just surprised that it happened, but also the timing. We know that BOJ's head is going to be stepping down in the spring. A lot of people wondering, why rush this now? Why not wait until the new year? And why zig and sort of, become more hawkish as one of the more dovish central banks when everyone else is trying to decelerate at least a little bit, not pivot, but at least ease off the gas a little bit on the hawkishness. So a really surprising move here.
Yeah, Rochelle, I always love an excuse to talk about the Bank of Japan, but you pointed out correctly that, Haruhiko Kuroda, the governor there, really living up to his reputation of surprising the markets with just a few more meetings to go until his exit come this spring. And, Bank of Japan, not one central bank that we talk about often on the show, but there is some context to be had here. To your point, it has been among the most major central banks, the most dovish, partly because Japan has really struggled to get persistent inflation above 2%. And they've had this yield curve control policy in place since 2016, essentially anchoring the 10-year JGB to zero. It's still anchored at zero, but as you pointed out, they're now allowing it to drift a little more. So 50 basis points as opposed to 25 basis points. And the thinking here is that if Japan, which has struggled for so long to get inflation ticking higher, is now looking at this change, what does that mean for the other central banks at a time when the markets, some have been expecting a bit of a pivot? If Japan's making this change and addressing inflation, then the question becomes, is there even a pivot in store for the Fed, for the ECB, for the other major central banks?
Exactly. I mean, we did see Kuroda try and sort of temper some of this down, saying, look, this is not a rate hike, but I want to have you look at this tweet from strategist Jim Bianco. He tweeted, if Japan, meaning given the dovish context, is now hiking to changing policy now because of inflation, remind me why the Fed will be pivoting any time in 2023. The answer is they will not. You can forget a pivot. So obviously a very strong reaction here. People wondering, what does this actually mean then? Can we really expect some of the enthusiasm that we see in the US markets? Are they just becoming a little bit too complacent, really still jumping the gun? Because as we know, Fed Chair Powell still hawkish, obviously still tempering things with a slowdown with the 50 basis point hike, but still not taking his foot off the gas anytime soon.
Well, and obviously, and this isn't necessarily contained. We're talking about the Bank of Japan and what happened over in Tokyo, but a lot of debt is held by Japanese investors, and this is sort of the contagion effect people are potentially looking at. If there is now yield to be had in Japan, are you going to start to see some of these investors exit these positions in the U.S., in France, over in the U.K., and then start going back towards investing in JGBs domestically? That's a big question mark, which is why we're seeing some big yield moves not just within JGBs, but treasuries as well as other bonds as well. It's going to be interesting to watch how this all plays out. But to your point, Rochelle, some would argue this isn't all about a tightening yet. There's a bit of a mixed message going on.
Indeed, and we're going to break down this conversation even further on the Bank of Japan's surprising change to the yield curve policy. We have John Hardy, Saxo head of FX strategy. Good to have you, John. I mean, when you look at what's happening with the FX markets, they don't seem to be convinced that this is just about sort of, the bond, just about making the bond yield and the bond market smoother. They're seeing this as more hawkishness.
Well, I think it is a shock to the market, first and foremost. The market was not expecting this to unfold under Kuroda's tenure at the Bank of Japan. As you pointed out, he is about to exit stage left come April. So you have this sort of general sense and noise level rising that the Bank of Japan would eventually shift, but it would likely be under new leadership. And we do have this one-off tweak. It is just a lifting of the cap on those 10-year JGBs, as you indicate. And a strong indication he attempted in the press conference, I think, trying to maybe mute what they knew would be a very strong market reaction to any anticipation that this would be, the beginning, the starting pistol for something bigger afoot here. I think it will be eventually, but that will be under the new governor. So, he says this is not a rate hike. I think the market reaction begs to differ. It was a rate hike. The market wasn't anticipating it, but I think the timing was a bit clever and that the market wasn't looking for it. It comes at a time when there's not this huge pressure on the Japanese yen, which was mounting so viciously before when dollar versus the yen was trading up at 150. Here we are in the mid 130s when this move unfolded. So, and I don't think it necessarily has any feed-on implications for the rest of the other central banks. But of course, when you have a major bond market suffering a major shift, it does see some contagion, and we do have the legendary Japanese saver here with their savings sloshing around the world and looking for yield. It changes the maths a little bit. It maybe changes the complacency on funding in Japanese yen to seek yield elsewhere in the world. So a big sort of margin call maybe on some of these types of trades as well.
John, I want to hone in on those comments that we got from Governor Kuroda during the press conference, because to your point, you can kind of read it in both directions. He said specifically this change will enhance the sustainability of our monetary policy framework. It's absolutely not a review that will lead to an abandonment of yield curve control or an exit from easy policy. Is there an argument to be made here that the tweak is in fact a strategy for the BOJ to make this YCC a little more sustainable because they're in it for the long haul?
I think it's in a way, it's a clever way to say, look, we are capable of moving. It is, if this is where the Bank of Japan stops and global yields start to march higher again, the pressure will immediately go back to the Japanese yen if the assumption is, well, the Bank of Japan, this is all they can deliver and they're simply never going to change anything else. Just by having that element of uncertainty, I think it buys them a bit of leeway if we do see a fresh rise in global yield. So, he can reinforce all he wants to. I think the market is already learning not to expect or trust too much what the Bank of Japan is saying now from meeting to meeting, when so recently Kuroda was defending the existing policy, and it sounded like there was just no anticipation that they would change. So, I think there is that element of just buying that uncertainty, have some optionality. Or bringing the idea of optionality into the market so that you don't see that runaway pressure on the Japanese yen the next time around.
John, I guess the question is, how much of what we're seeing in the markets today is a one-off on a surprise move from the BOJ? How much of it is going to be sustained? We saw the yen strengthen against the dollar. Are we likely to see this trigger a sell-off in dollar assets, or is this going to be pretty short-lived?
Well, I think there's a stepwise reaction here, and we've probably seen the bulk of that. I don't see any need for a chaotic further revaluation of the yen higher if there is no follow-up move. So I think to get a sort of a sustained move trend-wise, you would need to see global yields starting to march lower again, because after all, Japan still does yield a very small amount after this change relative to other global bond markets. So, the stepwise reaction here could last, the week or less in the short term. And then after that, you've reset, okay, looking forward, where are bond yields headed? Where's the global economy headed? Are energy prices going up? That's also a vulnerability of Japan. Part of the reason that aggravated and drove the yen lower are yields back on the march higher again, or have we not seen the lows because we're heading towards some global recession? The latter being more yen supportive, whereas a rise in yields, again, I think pretty quickly starts to temper this move after what I think is starting to be a fair pricing at current levels of yields at around 130 in dollar yen, so 130.
Yeah, and worth noting that even though we're talking about inflation at decades highs over in Japan, it's still 3.8%, which is pretty moderate when you compare it to where the rest of the world is right now. John Hardy, Saxo head of FX strategy, good to talk to you today.
Likewise.
Well, let's turn our attention back to the U.S. markets, and we're taking a look at tech stocks as the Nasdaq 100 index tests a long-term uptrend in place since 2008. Let's bring in Yahoo Finance's Jared Blickery, who's tracking that part of the action for us this morning. Jared.
That's right, Akiko. And let's begin by taking a multi-year view here. This is of the Nasdaq 100, as you were pointing out. Now, let me actually change this to a line chart so we can see this a little bit better. Clearly, we are hanging out in the bottom end of this range. So this goes all the way back to last year. Here is the top. Most of the markets, at least in the tech stocks, the tech arena, topped sometime last year, most of that occurring around November. And that's what we're seeing in the Nasdaq 100 overall. Now, you compare this to what's been happening with the Dow. You can see the Dow is way up here. So it's in the middle of its range. Quite a different story. And this has to do with what we were just talking about, tangentially, at least with respect to currency, the U.S. dollar, more people flooding into the dollar, the U.S. markets, because of the higher interest rates. Now, I just want to break down the tech sector a little bit more before I get into currencies and that effect. But here's what's happened over the last 7 days. Why 7 days? Because I want to go back to last Wednesday. Wednesday was the last Fed meeting, and that's when Chair Powell took the stage, and he was hawkish yet again. The worst performing sector since then is consumer discretionary. That's the worst performing sector of the year, followed by communication services, real estate, and tech. All of these down here are these mega cap sectors. So when we look at the Nasdaq 100, not surprisingly, we're seeing a lot of weakness. Now, one of the standouts here is Tesla. That's kind of its own idiosyncratic story. But when you delve down into various industries within tech, for instance, here are the semiconductors, you can see the semiconductors, which are very cyclical, very highly levered to the business cycle, very sensitive to what the Fed is doing. These were taking some of the biggest hits. And then you take a look at software, not the greatest story, but at least a mixed board here. So clearly the tech stocks that are most highly cyclical, most levered to the economy, those are the ones that are getting hit the most. A quick word on the yen. Money flowing back into the yen appreciating, that's not necessarily a bullish sign. That tends to happen, as a previous guest was saying, into recessions. That's when you see that money flooding back into the yen. The yen is the Japanese government is playing catch up with the US, and eventually it's all going to be catch down. In the meantime, I think it's a warning shot that there's a lot more, or potentially a lot more, consternation in the markets to come. Akiko and Rochelle.
Yeah, that's a good point, Jared. Also interesting to be watching whether this is going to be a one-day surge against the dollar, or whether it will in fact be sustained. Jared Blickery, thanks so much for that. Well, let's take a look at one of our trending tickers today. Shares of Lucid continuing to climb in this session. That stock is up more than 4% now after completing a $1.5 billion equity offering. The luxury EV maker raised a majority of that cash through Saudi Arabia's public investment fund, selling 86 million shares. The company structuring the funding round to limit the Saudi stake to 62%, which is where it was before this latest funding round. Now, Lucid says they will be using the cash to, in their words, further strengthen its balance sheet and liquidity position. Well, coming up, cryptic times in Washington. A divided Congress no doubt shaping up to be a big issue in 2023. But is the crypto industry likely to feel the impact more than any other? We're going to ask one man with his finger on the pulse next.
crypto is looking like a betting scheme rather than an investment scheme. But nonetheless, we have to make sure that consumers are, they can bet, they can invest in nearly anything that they want to. That's their right. But we need to make sure that they're operating in a fair environment, in a fair market where they understand the true risks and the rewards.
That was Minnesota Senator Tina Smith speaking with me earlier this morning. She's currently advocating for regulation and oversight in the crypto industry. Despite the clear need for action on regulating crypto, lawmakers remain split on what exactly needs to be done. Joining me now to weigh in on that and other D.C. policy matters, we've got Cowen Washington Research Group's Jared Seberg. Jared, the thinking here is that now you've got a divided Congress. Republicans historically was thought to be a little more friendly in terms of crypto policies. You think that's still the case, even in the aftermath of FTX's collapse?
Politics are all over the map now, right? That's what makes this so much fun now. When it comes right down to it, this is really a question of, what's going to keep lawmakers out of trouble when we come around to the next election. You see a lot of lawmakers who had advocated for one approach to regulation or no approach to regulation now climbing aboard the train to provide more government oversight. You've had lawmakers who have even thought about the issue getting vocal on it. The one consistent message is that the status quo doesn't work.
So then as we look specifically at some of the investment themes that we're keeping an eye on when you do have a divided Congress, what do you think is going to be the real ones that really stand out in 2023?
So, if you're looking beyond crypto, I mean, to me, the biggest investment theme is the debt ceiling and what happens to the United States credit and the Treasury market. And, can Republicans really negotiate in the House a agreement to raise the debt ceiling? That's probably the biggest macro threat out there. I would say, on the crypto front, I think it's going to be led by the regulatory agencies in 2023 and 2024, and then we'll see if Congress can come and reach a deal.
So what does that framework look like as you see it? I mean, what we've heard from the hearings the last few weeks is there's a divide among lawmakers, but also this talk of, there's crypto and then there's Bitcoin and Ethereum, which should be seen in a separate category.
You couldn't have said it better, right? I mean, right now, there's just lots of confusion. There are all different types of digital assets. There's technology, there's the trading of these assets, and then there's the use of digital assets as products. And I think you're going to see different regulatory responses based on, what the use case is. We heard from the CFPB last week that they are on the hunt. If, tokens and digital assets are used for consumer payments, or if there's something that resembles a loan or a savings account, they're going to assert jurisdiction. On stable coins, you're going to see, I think, the bank regulators really step in. And then we've already seen the SEC and Gary Gensler argue that most tokens resemble securities, and you're going to see a disclosure regime for them. So, it really comes down to use case. There is not going to be a one-size-fits-all solution to crypto because crypto is simply too big and too diverse.
And so then in terms of the scrutiny that could still be ahead for the industry and for some of these other issues, things like antitrust, some of these companies that have taken social stands, how do you see that playing out?
Okay, so the antitrust issue is interesting because, in a decentralized environment, theoretically, there shouldn't be antitrust concerns. But I mean, you do hear this come up. And we certainly have a very aggressive Justice Department and Federal Trade Commission. So I do think you will see some discussion and talk there. On the social justice side, that's a really big question because you can take that down many paths. You have a lot of progressive Democrats who believe that a central bank digital dollar is really a solution to providing financial services to the unbanked. You can certainly argue that many stable coins or even some crypto tokens themselves, even Bitcoin, can be very efficient and cost-effective ways for lower income people to receive and move money. And I think that's a real political, real political asset for this space. And, we really, I think, need to see them use that much more aggressively in talks with Capitol Hill and regulators over the next 2 years.
All right, well, do thank you for joining us. Cowen Washington Research Group's Jarrett Seberg, thank you so much. All right, well, meme stocks are seeing a bump this morning and a mild market rebound. AMC recently hitting its lowest level since January of 2021. We've got Yahoo Finance's Ines Ferrer with the latest. Hey, Ines.
Hey, Rochelle, that's right. AMC yesterday was at a 52-week low, and I did get comments on Twitter after I wrote about this. Look, AMC year-to-date, I'm going to pull up a chart on our Wi-Fi interactive board so you can see the meme charts now, the meme stocks here. Year-to-date, the stock is down 82%. And I want to bring your attention to this APEs, the APE units that were issued earlier in August. This is the preferred equity program that AMC came out with, down 88%. At the height of this program, APEs were at $10.50, now trading at around almost 70 cents per unit. But Adam Aron, the CEO of AMC, he's been on Yahoo Finance before. He tweeted out yesterday saying that APEs let the company raise $162 million in cash in the past 90 days. So the company has been using this tool to raise money to be able to also cut part of its debt obligations. And the company has also been very sort of innovative when it comes to leaning into its shareholder base, the retail traders, a nod to the APEs out there, partnering with Zoom, investing in gold mining, all sorts of things. But nonetheless, the stock has suffered this year. GME is down year-to-date 45%, pulling up that year-to-date chart once again. The levels that GME is seeing they haven't seen since May of 2022. And finally, I just want to point out what's happening also with BlackBerry, because BlackBerry will be reporting its quarterly results today after the close. The Street's expecting a loss per share of 7 cents on revenue of $168 million. Year-to-date, this stock is down about 55%. So we knew coming into this year that it would be difficult to repeat a meme frenzy that we saw last year in 2021. Going into 2023, Brian Sozzi has written about this recently. It will be even probably more difficult for these meme stocks. Liquidity is drying up. The cost of borrowing money is more expensive. And perhaps also investors are sort of graduating into other assets, guys.
Yeah, that's what we've heard more and more about retail investors kind of looking beyond the traditional meme stocks. And as Frey, as always, thanks so much for that. Well, it's now time for our chart of the day. And today we are taking a look at global central banks and their rate hiking cycle. Josh Lipsky, friend of the show from the Atlantic Council, points out that in the past, it may have seemed like central banks were all operating on a united front to control inflation. But 2023 is going to look a lot different. This chart shows the variation of central bank projections across the globe, something we can likely expect to take effect next year as countries shift their focus on their own economic issues rather than focus on global forces. And to the conversation we had earlier, you see Japan at the right above China towards the bottom of that chart there. Well, coming up, going up in smoke. Legislation creating a safe harbor for the legal marijuana industry fails to make the government's spending bill. So is there hope for a standalone measure next year? We're going to discuss after the break.
Now to the debate over safeguarding the legal marijuana industry. Legislation to open banking services to the sector, known as the Safe Banking Act, has been left out of a $1.7 trillion government funding package. Now, not hard to gauge the reaction of some of the major players on the news. So joining us now to discuss this what's further for the industry is Yahoo Finance's own Rick Newman. This can just keeps getting kicked down the road, Rick.
Yeah, so it looks like the Safe Banking Act is not going to be part of this bill that Congress passes. And I think the Democrats who still control Congress until next year, I think they just ran out of time. There's been a lot going on in Congress, Ukraine funding. There's a long wish list of things members want to get passed. And the Democrats basically decided not to go to the mat for the Safe Banking Act. So this could put it off until all the way into 2025, I think, because the Republicans will control the House for the next 2 years. And they're lukewarm on this at best. The best shot for getting the Safe Banking Act passed was with Democrats in control of Congress. So Democrats unable to do it. That means we may not see this in 2023 or 2024 either, Rochelle.
Rick, I mean, what does this mean for the industry itself? Some would argue that there's been a lot of skepticism of this passing in the first place. Maybe it's already baked in, but there was a lot of hope, at least in the lame duck session, that something could get done. Yeah,
so the legal cannabis and legal marijuana business, which is operating in most states in one form or another at this point, I mean, it's basically a cash business. These businesses, these are real businesses, but they cannot get banking services, so they have to find workarounds. Cash or I don't know what else, crypto, and that is going to limit growth potential. It's certainly going to limit the upside outlook for some of the marijuana ticker symbols. It's just going to be slow going, even though, I mean, here in New York City, for instance, I mean, these businesses are raring to get going. And it's just going to be a lot slower moving forward than it would be if they could get normal banking services.
It looks like it's going to be that piecemeal approach, at least for a while. Perhaps, as you mentioned, in 2025, a long way away. All right, a big thank you there to our very own Rick Newman. All right, coming up, good faith bargaining. 2022 was a landmark moment for the labor movement in the United States, and there's no doubt Chris Smalls has been the poster child. But the hard part is negotiating the contracts. Where are we on that? We'll get this take next. Big tech firms are gearing up for more labor activism in 2023 after seeing an unprecedented rise in union organization this year. Now, Apple and Amazon both felt the effects of these efforts as they tried to navigate the path ahead. Well, joining us now with more is Yahoo Finance's Ali Garfinkel. This really has been an incredible year for unions.
It really has, Rochelle. And there was a time where unionizing in big tech seemed completely impossible, but here we are talking about it. And I think it's worth starting where things are at for Apple right now. You have the Maryland store that's preparing to start negotiating its contract early next year. And I was talking to a worker at the Oklahoma City store just yesterday, and what he was saying is he is also eyeing the beginning of next year for negotiating their contracts. And it's worth, tying this in with Amazon a little, because even though I would argue that Amazon workers and Apple workers are in very different situations, they have one thing in common when I talk to them. They say that this will not stop in 2023. Macro be damned, labor organizing in tech isn't going away. That's the message I've gotten from workers across the board, Rochelle.
Ali, I guess there's a question about how much leverage workers have as we continue to see the labor market slow a little more, right? When it was a tight market, they had a lot more leverage. You mentioned Amazon. What's the next step here in terms of its union push?
Yeah, Kiko, I think that's a great question because the reality is, in Amazon's case in particular, but for Apple too, they have a deep challenge. Contract negotiations take a lot of time, they take a lot of resources, and companies are incentivized to stall for as long as possible. The average negotiating period, Kiko, takes about 465 days, according to Bloomberg. So it's going to be a long haul. And I think as much as there's this message of this isn't stopping for workers, I think there's also going to be pressure on these unions to deliver results in 2023 against a lot of odds.
Ali Garfinkel with an update there. Thanks so much for that. Well, we're going to continue this conversation on the union push we're seeing in big tech and across all industries with Chris Smalls. He's the president of the Amazon Labor Union. Recently penned an op-ed in the New York Daily News about Amazon's worker conditions and its dominance on the internet. Chris, as we said, you've kind of become the poster child of this union movement this year because of that historic win that you got back in April. You just heard Ali say these negotiations take a long time, just standard 465 days. How optimistic are you that something can get done in 2023?
Well, I'm very optimistic. We are very well prepared for the long haul of this battle. We understand the odds that we have to defeat and the odds of getting a company like Amazon to come to the table. But at the same time, we're in a different point in time in history. And when it comes to organizing and with the efforts of, Amazon, Apple, Starbucks, you name it, Trader Joe's, all these workers and industries that are coming together now, corporations have no choice but to realize that this movement is not going to stop and not going to rest until we rightfully get what we rightfully deserve.
And Chris, how far apart are you on negotiations right now?
Well, at the current moment, we're waiting to be certified. We've been in court for nearly 5 months. That was a few months ago. The board has ruled in our favor. Any day that they certify us, we're going to immediately put in a bargaining order for Amazon to come to the table as soon as that happens. So we're waiting any day. I don't have a time frame, neither do my lawyers. We are being told as directed and as we receive information. So as soon as we get that certification, which can be any day this week, any day next week, we're going to file to have a bargaining order for Amazon to come to the table right away.
Chris, there's certainly been a lot of talk about organizing at Amazon warehouses, facilities, but since that historic win in April, you've had 2 unsuccessful elections. You're an independent union. I wonder how you keep the momentum going. Is there talk of you maybe doing a tie-up with other unions? What's that conversation looking like right now?
No, Amazon's been around for 28 years, so we don't look at them as unsuccessful. We look at them as growing pains. There's going to be wins and losses, and it's only a loss if you give up. Neither campaigns has suspended. They are still organizing. And we're learning things as we continue to organize. The only way we're going to get Amazon to come to the table is by taking shots and taking risks. And these happen by workers being ready to organize in their perspective facilities. So for us, whatever campaign is ready to go, the Amazon labor union is going to throw their support behind it, no matter what. And we think that, and we believe that, multiple efforts are going to take off this year and next year. And we know that it's going to take a collective action for Amazon to come to the table. So for us, it's never unsuccessful. These are growing pains, and we're going to continue to fight and we'll continue to grow.
Let me press the point, though, Chris, not necessarily about you giving up on organization. Nobody's expecting that. But as the Amazon labor union, is the thinking that you want to just operate on your own entity, that you want to just operate as an independent union? Or are there conversations of tie-ups with other unions to really increase the pressure on Amazon?
No, how can we increase the pressure on it with other unions? There was no pressure. We were the first ones to do it. I know that we're independent, and I get that established unions have a lot more money and power, but we have to start somewhere. And the way we organize, the way that our culture was created, solely ran by Amazon workers, putting workers in the driver's seat, we have a different mission, the same struggle, but a different mission. Our mission is to represent Amazon workers, just like Teamsters represent UPS drivers. So we want to grow, and we have to start somewhere. So they have to give us a chance, and workers have to take a chance with us. Understand that this is different. This is brand new. This is something that we created, but it's something special. It's something that workers have full control over, full power, being in the driver's seat and being at the negotiation table.
And we know that with other companies, say Starbucks, for example, after sort of trying the stick method, they went with the carrot method, offering some of these non-unionized stores, better benefits and things like that. Is there anything that you think Amazon is trying that would perhaps undermine your efforts, especially when you look at things like recession fears and people wondering about their jobs?
Yeah, of course. Amazon plays into rumors very well. They already put out things like, they're firing 10,000 workers, then it's 20,000. And they don't really clarify where that is, but we believe and we understand that it won't be a JFK8, for example, won't be a building that's unionizing, for example, because it's illegal actually to do anything. And because we won our election, so that actually is a way of protection for us. And we understand that Amazon is going to play into other union busting tactics, but we have to educate our members as well, and we have to educate the mass. And that's what we spent a large portion of our campaign on. And we continue to do that every day. We have to understand that workers in the working class in this time and age, they don't understand how unions operate. They don't understand the time framing of everything. And it's up to us as leaders and as organizers on the ground to make sure that we bring that bridge together. And we make sure that we have these conversations in our own neighborhood, in our own households, so that when you go to work and you talk to your coworkers and colleagues, you understand that this process is a very long process, and that if we're going to get what we want, we have to come together as people. We cannot be divided. We can't allow the company to divide us.
And as you mentioned, obviously, Amazon has changed a lot from when it first started to where it is now, and the sort of the reach that it has. What is it that you would like people to understand about why you're doing this, considering how Amazon has grown and the sort of now the work and the sort of pressure that workers are under?
Once again, Amazon's been around for 28 years, and Amazon has exploited millions of people in this country. If you think about what the percentage is of they hire and they're firing, 150% a year. You're talking about 200, 300 people losing their job every week. You're talking about people getting injured every day, a high rate of injury rates. You're talking about grievances that you never even hear about. These things happen every day. I get emails from workers all over the country. So for me, I can't stop. I can't sit here and be complacent about the malpractices of this company, knowing that I worked there myself, knowing that I went through and lived these grievances, and knowing that these workers deserve better. So my fight is their fight, no matter if I'm still employed or not. And I'm going to continue to advocate for workers' rights, no matter what industry And for us, this is the only fight that's important right now. If Amazon gets through and gets a contract, that's going to change the whole labor market, the labor movement forever. And we're going to continue to once again organize. We're not going to stop.
We'll certainly be keeping an eye on that and the further developments that come between you and Amazon. A big thank you, Amazon Labor Union President Chris Smalls. Thank you for joining us this morning. All right, coming up, from Google to Apple and Amazon, it's been another year of EU antitrust efforts against big tech. How much of a problem is this becoming for their bottom lines, though? Yahoo Finance's Dan Howley joins us to discuss. The European Union's antitrust battle against big tech rolls on as the EU is dishing out charges and reaching settlements with the likes of Meta and Amazon over the use of user data. Yahoo Finance's Dan Howley has been following this story for us. Dan, what's the latest?
Yeah, so we have a Amazon settlement with the EU going on with regards to some antitrust charges. Essentially, what was going on here was similar to what the U.S. has accused Amazon of, or members of Congress accused Amazon of, where Amazon was using third-party data for products to then make their own competing products and then sell those against sellers on their own website. They also were placing Amazon products in the so-called buy box more frequently than third parties. And so the end result of that would be beneficiary to Amazon and hurtful towards third-party sellers, because Amazon would naturally have access to data that third-party sellers would use to better their products, and they also had better spacing. Now, Amazon contends that this is not the case, that they disagree with this wholeheartedly, but they are agreeing to amend their business practices. They're not paying any fines in this particular instance. They're agreeing to amend their business practices where they do not use third-party data to go ahead and make new products or make competing products. And they also would allow third-party sellers to appear more regularly in that so-called buy box. So that's a big deal for Amazon to do that in the EU, considering it's something that we've seen, as I said, Congress here in the U.S. complain about and take Amazon to task over. In fact, members of Congress had asked founder and former CEO Jeff Bezos if Amazon was actually using third-party data to create their own products, and they said he couldn't be sure that that wasn't the case, although they had kind of tried to push employees not to do so. So, this kind of settlement in the EU could mean changes coming in the U.S. as well, if that's the case. Now, there's other, obviously, big antitrust issues going on in the EU. We have Google, for instance, contending, Alphabet, continuing to contend with a number of different issues, as well as Meta parent company Facebook. They recently were in trouble or sent a statement of objection from the EU, basically saying, look, we think that you having Facebook Marketplace tied to the standard Facebook app is a problem. It's unfair to competing services, and that it essentially needs to be separated or should be separated. So, there are these ongoing issues that we see in the EU, and it does kind of show you that they are pushing forward more diligently or at least more aggressively than here in the U.S., where things really are kind of moving at a snail's pace.
Dan, that begs the question, what happens to the one company you didn't mention yet, which is Apple? What is it looking like for them in the EU?
Yeah, so they're going to have to change up their app store. This is something that's going to happen with the Digital Markets Act. That goes into effect in January, and it's enforceable in 2024. But Apple's already working on the technology to go ahead and allow third-party app stores to be built for the iPhone and iOS and iPad OS. It doesn't matter with Mac OS. You can download stuff from the internet anywhere for your Mac, but not on your iPhone or your iPad. So it looks like that's going to be changing in the future for Apple. And, I had seen a note from analysts who'd said, this isn't necessarily going to be, the end of the road for Apple in the App Store. On the contrary, people are just more comfortable using the Apple App Store. And, even if there's a huge discount, 25%, between using a third party and using Apple's App Store, people are still going to use the Apple App Store because it's more convenient, it's more trustworthy, and it's what they've been using for a long time. Google allows you to install third-party app stores already, and people still use the Google Play Store. So, I don't think it's going to be a huge pain for Apple, but it could be something that we do, again, eventually end up seeing here in the U.S. as well.
Certainly not going to slow down anytime soon in terms of the EU's crackdown on big tech. Dan Halley, thanks so much for that. Well, coming up, that's a wrap. Imagine going to the theater all set for a 3-hour, 12-minute long Hollywood extravaganza, only for the screening equipment to fail. Yes, we're talking about the new Avatar here that happened to moviegoers in Japan. So what's going on? We'll discuss next. Avatar, The Way of Water, one of the most expensive productions in Hollywood history, experienced a number of technical difficulties across Japan in its critical opening weekend. Some theaters had machine troubles, others were forced to lower the frame rate of the film to be able to screen it, issues that have fallen prey to Japan's dated cinema industry. Rochelle, this is kind of I guess we come to expect James Cameron film. It's got the latest technology in there. If you think back to the original Avatar, it was kind of the first big 3D movie. I mean, these theaters just weren't ready for it. But also, my question is how that affected sort of the turnout for the first weekend. Because yesterday we saw a big reaction to what was, sort of less than stellar, although it was pretty strong performance in this first weekend, at least here in the U.S. Have you seen it?
I've not seen it, and as much as I think it's beautiful, I'm just not that pressed to see it. I don't know why. I think it's because
it's
it
3
just feel
hours,
like
more than 3 hours.
That I was like, already that's off-putting. And then I don't know. I feel like some of the movie magic, like usually there's a couple of blockbusters out at the same time. I mean, pretty much it's just Avatar right now in terms of what came out over the past weekend. And we know that James Cameron says it needs to hit $2 billion in order for it to really sort of break even and be successful. And I mean, some people on Japanese social media, when they were talking about these projection failures, saying, look, some had to give refunds. And as you mentioned, like slowing the frame rate down from, I think it was 48 per second to 24. When you put that much money and effort into a film of this scale, and then for it not to show properly and to have fans disappointed, doesn't bode well. I mean, I'm assuming people would come back and try and see it if they've trudged all the way out there to come and watch it. But I mean, it's disappointing. And I don't know what that means for other movie theaters in other countries who don't have the same technology to keep up as well, what that's going to end up doing to the final numbers.
Yeah, I mean, I will say, to your point, that the technical side of this is just as much of an attraction as the storyline itself. I haven't seen it yet, but it is one of those movies where you think if you're going to watch it, you definitely have to watch it in the theaters. By the way, they showed it across 1,466 screens nationwide in Japan. That is a record, apparently. But they didn't take the record in the first weekend at the box office. So maybe that points to some glitches that we saw play out at the theaters. Let's do a final check on the markets before we let you go. We saw some green arrows across the board at the top of the show, and now we've seen the S&P 500 and the Nasdaq turn negative. The S&P 500 pretty flat though, and the Nasdaq down about 13 points. That does it for Rochelle and I in this hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.